All right. Okay. So let's start from the back to the beginning. Talk about time payment of claims. We've already discussed that, but let's go over it. Remember, they have to pay us immediately upon receiving proof of loss. The word immediate, I went over that with you guys, letting you know that the test question may ask you how quickly does the insurance company have to pay a claim after they get the proof of loss? And the answer could be immediate, and that would be correct. But remember, as we get into this, there is you gotta give them at least 60 days. So you can't file a lawsuit against them because they haven't paid you until 60 days goes by. So immediate is probably correct when you see it, but the more accurate answer would be they have 60 days to make the payment. And disability benefits have to be paid at least monthly. Disability benefits can be paid weekly and twice a month, but they can't pay them quarterly, semi-annually, and annually. Payment of claims, those traditional policies we talked about, the reimbursement policies. Remember, we file a claim and the insurance company sends the money to the insured. But if the insured dies before the money gets there, then it's going to go to the beneficiary that person would have named. And if there's no beneficiary, then it goes to the estate of the insured. And I don't make that too clear there, so I want to make sure it's clear to you. It doesn't go to the estate of the beneficiary. If the beneficiary dies and the insured is dead, it's going to go to the estate of the insured. Physical exams and autopsies. I mentioned to you, okay, if an insurance company wants a physical exam or an autopsy, they have a right to it. They have to pay for them. And someone asked about why would they want autopsies, and just to make sure this is on the recording, that was a great question. If perhaps there was a suicide with life insurance, there might be a suicide within 2 years, and there's a suspicious, they're not sure how they died. Well, they can conduct an autopsy to see if in fact it was or was not a suicide. There may be other reasons, but that would be one of them. Regardless, if an insurance company wants a physical exam, they can have a right to it. If they want an autopsy, they have a right to it, but they have to pay for it. Time limit on certain offenses, also called the Incontestable Clause. And as I mentioned to you earlier, sometimes they call it the Contestable Clause. Sometimes they call it the Incontestable Clause. It's all dealing with that 2-year time period. When the policy is in force for 2 years, the first 2 years, the insurance company may contest any answers on the application. Once it's been in force for 2 years or beyond, then the insurance company may not contest. So sometimes they call it a contestable clause, sometimes incontestable. And in health insurance, those guaranteed renewable health policies, which is like 90% of them, become incontestable after 2 years. And as a reminder, I wanted to make sure you had a reminder about the fact that pre-existing conditions do have a 2-year look-back rule. Even though the Affordable Care Act no longer deals with pre-existing conditions, that doesn't mean they're not going to ask you about it on the test. So back to that immediate, right? When do they have to pay us immediately? Well, 60 days. If you're worried that they're not paying you and you want to sue them, you have to wait at least 60 days. But you have to sue them within 3 years, or you might lose your right to sue them to get your money. Now, I went through this. I'm not going to spend a lot of time on it, but whenever we pay premium from today forward. Matter of fact, here's my slide on it. Whenever we pay premium, we're paying in advance. So if we pay $100 for 30 days worth of insurance, doesn't matter what kind, if the policy is canceled on the 15th day, the terminology we're going to use is the insurance company has earned $50 or half the premium because the policy was only in effect for half the time, and there's $50 of unearned premium. And the client is entitled to some or all of the unearned premium when a policy cancels. Now, it is rare that an insurance company can cancel the policy in the middle of a term. They can cancel a policy for non-payment of premium, but non-payment of premium, there's nothing to get back because you didn't pay your premium. You blew through the grace period, and there's no refund of premium that was not paid. This is in case the insurance company cancels, which is rare, but it might show up on a test. So if the insurance company cancels, then we use the phrase, it's a prorated refund of unearned premium, which in my example means a customer is going to get back $50. But if the customer, the insured, cancels, the insurance company is allowed to keep a few of those unearned premium dollars to make up, to help them meet the costs of cancellation. So you're short a few dollars. It's called a short rate refund. Just be aware of the difference between what does short rate mean, what does prorated mean, and what would generate which or the other. Company cancels, prorated. Insured cancels, short rate refund. Oh, and I know I was going to get rid of that, and that's when everything went crazy on me. Forget about that. Then we got into the optional provisions. And again, the world of life insurance and health insurance is a little different. In life insurance, occupation is a factor when you apply for the policy. If a person changes their occupation once the policy is in effect, then the insurance company cannot do anything about it. However, with health insurance, occupation is always a factor. It's a factor at the time we apply, and if we change our occupation during the term of a contract, the insurance company, if they use this provision, called the change of occupation provision, then the insurance company, if a person goes from as I said, a librarian to a race car driver and does not tell the insurance company would then have a right to adjust the benefit, applying the premium that was paid based upon the fact that the individual was a librarian against the risk that they're now a race car driver. The insured is basically not going to get as much money. So when they change from less hazardous to more hazardous in health insurance, this change of occupation provision allows the insurance company to adjust the benefit. Now, if somebody goes from a more hazardous job to a less hazardous job and doesn't tell the insurance company, as I said just a few minutes ago, I think that'd be really silly, because if we're aware of what's going on, if you change your job in health insurance from more hazardous to less hazardous, you go from a race car driver to a librarian. If you tell the insurance company, they're going to reduce your premium. If you don't tell them, when they find out that you have done that, they will give you a prorated refund of unearned premium, because they're not going to be able to keep more than they were entitled to, nor do they want to pay out more in claims than they have to. It's kind of the way it works. Misstatement of age or gender. Misstatement of age or gender. If people lie about their age, the insurance company finds out about it, insurance company is going to adjust the benefit that would have been paid based upon the correct age or gender. And it's gender at birth. Gender at birth. Gender at birth. Illegal occupation. This is health insurance. This is not life insurance. This is health insurance. If we have a bank robber insured with our health insurance policy company, the insurance company has to pay the claim unless they get sick or hurt or injured, injured or sick as the result of the illegal occupation. So if a bank robber gets shot holding up a bank, this provision allows the insurance company to not pay the claim. If he gets hit by a car helping some little old lady cross the street, they'll pay the claim, because as you can see, the injury or illness must be a result of the illegal occupation. And if that would be the case, then this provision, called the illegal occupation provision, would allow the insurance company not to pay the claim. Question about the insuring clause. Where is it? This is both life and health. The insuring clause is almost always on the first page of the policy. And what does it do? It identifies who the insured is, who is the insurance company, and what losses will be covered. It spells it out, because the contract, it needs to be clear. Almost every insurance policy that's issued, the insurance company wants to know who are the named insureds. The term they're looking for, they want to be able to identify, excuse me, but about a second, they want to identify the named insureds. Who are they? They want their names. They want to know who they are. There's one exception to that rule. We'll be talking about it in a little bit. Free look. We've covered this in class, I know. Free look period. Every health and life insurance policy has a free look period that will begin the date the policy is delivered. Normally, it's 10 days. The only exception would be for long-term care insurance and Medicare supplement policies. Because long-term care insurance and med sup policies, there's a 30-day free look. Watch for those questions on the test. They seem to show up a lot. So know the distinction. The standard would be 10 days. The only exceptions would be long-term care policies and Medicare supplement policies. And also, coverage is enforced during the free look period. So if a loss comes in during the free look period, the company's got to pay. Of course, the free look period is over. They're not going to be so generous as to pay a claim, and then you turn the policy back in during the free look period and give you your money back. Once you accept a payment from them in the form of a claim, the free look period is over. Also be careful, it's not free insurance. It's a free look. You have to pay so you can see it, kind of like going to the movies. You don't get in to see the movie unless you pay, so it's not free insurance. The difference is between a movie and an insurance policy, if you don't like the movie, you don't get your money back. If you don't like the policy or any little minuscule thing about it, they will give you a full refund of all the premium. They will give you a full refund of all premium if you turn the policy in during that free look. But it's not free insurance. Consideration clause. When we talked about contracts, we talked about consideration, the value that's exchanged between the parties. And every policy of life and health insurance has a consideration clause, and it's usually always on the first page. Matter of fact, many companies incorporate the consideration clause with the insuring clause because they're in the same place. But what it does, it spells out more clearly that the customer's valuable consideration is the application and premium, and it'll basically state the application is attached to the contract. Because we talked about it when we talked about elements of a contract. The application and premium is the customer's consideration, and the company's consideration is its promise to pay. Disability income policies have what's called an elimination period. An elimination period. Now, we have medical expense policies that pay hospital bills and doctor bills because you get sick or hurt and need medical attention. But think about a disability income policy replaces the income if you are disabled and can't work. So we have what are called elimination periods with disability income policies. They serve the same purpose as the dollar deductible on a medical expense policy. The longer the elimination period, the lower the premium. The higher the deductible, the lower the premium. They have the same function. Also, I want you to make a note. As a matter of fact, it just came to me. So I'm sorry, wrong note. There is a question. Why are deductibles a part of the contract? And the answer is something like to avoid overuse. In other words, a deductible is there to give the customer a second, this is what I'm, hold on a minute, what did I do? I don't know what the hell is going on with this thing. I have no idea what's going on with this thing. Man, oh man. Resume the slideshow. What's going on? There we go. This is where I want to be. Deductible. Question. Let's go back. What's the question? The question revolves around why are there deductibles in medical expense policies? And as I had typed out earlier, to avoid overuse, to help to make people not use that policy just because they stubbed the toe. Okay, if you stub a toe, you put some ice on it. If you didn't have a deductible, you might just run to the doctor, and that would be overuse. So the deductible is there to avoid overuse. It also reduces the premium, but that's one of the answers to one of the questions about why is there a deductible, to avoid overuse. So, waiver of premium. I know we talked about this yesterday in class. We talked about it from the standpoint of life insurance. If a person is totally disabled, they have to wait 6 months, make their payments for 6 months. Well, I made you write it down. I'm almost sure I said make a note. In health insurance, it's 3 months. So if a person has a disability income policy, and they become totally disabled, then the insurance company says, you're totally disabled. Well, you still got to make your payments. You got to make your premium payments for 3 months. And at the end of the 3 months, if you're still totally disabled, they'll refund you the 3 months you paid. And then they'll waive off future premiums for as long as you're totally disabled. But look what it says at the end. It says, if disabled prior to 65. This is identical in concept to what we talked about yesterday in class with life insurance. The only change is the number of months. So there's nothing new here other than the number of months. Also, yesterday in class, we talked about recurrent disability. If you remember, I used the word relapse. Think about it. I had a person who was totally disabled, was out for a year. Then they went back to work. And within 6 months, they had a similar related event. That's called a reoccurrence or a relapse. What does that mean to us in English? It's a continuation of the original disability, and therefore there's no new elimination period, but they've used up so many days of their benefit period. If the illness or the cause for the disability reoccurs after 6 months, now it's considered a new disability, and there's a new elimination period and a new benefit period. They reset both of them. Residual, on the other hand, is a different concept. And these are part of the policy. These are terminologies in the policy. And I'm going to send you a glossary. I promise you I will, and I will send you a glossary that you can look at. The word residual basically says the disability income policy is going to pay a benefit based upon the percentage of pre-disability income that was lost. So here's how it works. Let's assume that somebody is making $5,000 a month. They have a policy that will pay them $3,000 a month benefit if they're totally disabled. They've selected a 30-day elimination period and a 5-year benefit period. Let's assume he's had a heart attack, out for a year. Well, now here's where the residual concept steps up. So during that year, that person has lost 100% of his pre-disability income. So the policy is going to pay 100% of its benefit, $3,000 a month. If, however, after the year is up, he goes back to work part-time and makes $2,500 a month, they're not going to cut him out at the knees. They're going to say, you've lost half of your pre-disability income. We're now going to pay you half the benefit, or $1,500. So visually, here's what it looks like. When the person was totally disabled and not working at all, that policy's full benefit was $3,000. They lost all of their income. They get all of the benefit. But when they go back to work, and let's assume they make $2,500, they've only lost half of their income, and the policy is going to pay half of its benefit, and now they got $4,000 a month. See, this is an incentive to have that person go back to work. It's kind of like a sliding scale. That's what we mean by residual. There used to be, under some disability income policies years ago, what was called partial disability. And they pretty much eliminated that from contracts because partial disability paid a partial benefit if you were partially disabled. But if you went back to work, you lost your benefits. So they had to rework the terminology and the definitions, and they came up with this idea called residual. So if you do go back to work and you can't work at full speed, so you're not making as much money, they will give you a portion of your benefit. Coinsurance, stop loss, out-of-pocket maximum. We discussed these yesterday. Coinsurance is expressed in terms of percentages, right? First, you have to pay your deductible, and then the company's got to pay the larger of some percentage that'll be identified in the policy. However, policies have what's called a stop loss limit. It's a dollar amount identified in the policy. And basically it says when the bill hits the number equal to the stop loss limit, the insurance company pays 100% of the bill from that point forward. Think of it, the insured stops losing. So stop loss means the insurance company's got to pay 100% after stop loss. Then out-of-pocket maximum. That's the maximum exposure for the insured. I don't know if we went through this. I have a recollection we might have, but it doesn't hurt to go over it again. So if we know the deductible, whatever it happens to be, and we know what the coinsurance is, and we know what the stop loss limit is, we can calculate the most he's ever going to have to come up with. So John has a major medical policy. Here's an example. It makes it work. $500 deductible, 80/20 coinsurance, $5,000 stop loss. The hospital bill is $3,000. How much will he pay? Well, the answer is $1,000. The answer here is not as important as knowing how we get the answer. So if you look at the question, we look at the bill's $3,000. The fact that there's a $5,000 stop loss in this particular question is of no consequence. It has no impact because the bill is only $3,000. If the bill was more than $5,000 or more, now it's a problem, but or a consequence. But we got $3,000. That's what we're going to do. So here's how it works. The bill was $3,000. Deductible $500. Subtract. Leaves a balance of $2,500. And according to our question, the insurance company is going to pay 80% of the bill, and the customer will pay 20%. So 20% of that balance is another $500. Add them back together. Add the deductible and the coinsurance back together. That's where we get the $1,000. You got to do it in the right order. If you don't do it in the right order, you're going to get the wrong answer. And you think and they word it in such a way that you're going to think you got the right answer because they put down the other three answers that are the most common errors people make in the math. So, and I don't know if I told you this, but you're going to get a calculator, like a drop-down menu on the screen, on the computer screen, or they're going to give you some piece of plastic cheap calculator they got from a dollar store somewhere. But you'll have a little calculator to do these silly math problems. And they are simple, but you have to do them in the right order, okay? Let's take that example a little bit further. So now instead of the bill being $3,000, the bill is $18,000. Everything else is the same. So now, how much will he pay? Well, before I get to that, we have to look. The bill is $18,000, but the insurance company is going to pay 100% of the bill above stop loss. So we're going to focus on starting our calculation here at $5,000. The answer is $1,400. And here's how we get there. The bill is $18,000. Stop loss is $5,000. He only shares in the bill up to the stop loss. Therefore, that's where we start. Subtract the $500 from that because he's only sharing in the bill up to that $5,000. Then multiply that answer by his coinsurance. Make sure you add them back together. That tells you how much he pays. Now, they have a variation on the theme. Similar question, but they may ask, how much does the insurance company pay? Well, don't try to recalculate it. In other words, don't try to figure it out using the 80%. Figure out how much the customer is going to pay and then subtract that answer from the bill. In this example, if I had gotten a question that says, how much will the insurer pay, I would still go through the routine of getting this number. Once I get this number, I'll subtract this number from the bill. And that's going to tell me how much the insurance company is going to pay. Because remember, the insurance company is going to pay everything over $5,000. We've already accounted for how much he has to pay within the first $5,000. Coinsurance, remember, percentages. Deductibles. Deductibles come in different flavors. We have annual deductibles, per occurrence deductibles, family deductible, corridor deductible, common accident deductible. Let's talk about annual deductible. This is the most common. That means you must meet your deductible before the end of the year, or the insurance company's never paying anything. Kind of like your car insurance. If you have a $500 deductible on your car insurance and you have a fender bender and it's going to cost $300 to fix your car, that's all on you. If it's going to cost $600 to fix your car, you're still paying the first $5. Same idea. But annual deductibles have what's called a carryover provision. A carryover provision. And that could be on your test. So let's discuss what's going on here. Let's assume we have an individual who has a $500 annual deductible. And he goes to the doctor in June and he pays $100. Goes to the doctor in October, pays another $100. Goes to the doctor in December, pays another $100. Cheap doctor. This is all on him because he has not met his deductible. So without the carryover provision, what's going to happen, come January, his deductible resets back to $500. Well, that's not what happens if you have, and annual deductibles have this, it's called the carryover provision. So any money the person spends in the last calendar quarter will carry over to the new year, so that instead of his deductible in January being $500, his deductible in January, in this example, is now going to be $300. They carry over the deductible he paid, the money he paid toward his deductible in the last calendar quarter. Only the money spent in the last calendar quarter. I hope that makes sense to you. Carryover provision. Per occurrence deductible works like your auto insurance. Every time you have an event, you got to pay a deductible. This is very rare in health insurance, but you might see it on the test. It's very similar, as I said, to auto insurance. Family deductible. My mother was the oldest of 21 kids, same mom and dad. If Grandpa had a health insurance policy, even with a $100 deductible on each kid, he'd have gone broke before the insurance policy would have paid anything. So what the family deductible does, it'll cap out the deductible, meaning they'll waive the deductible once 2 or 3 family members meet the deductible. Okay, it's a break for large families. Then we made a special attempt yesterday, I think it was yesterday, to make sure you focus on a card or deductible. Supplemental major medical policies have card or deductibles. Supplemental major medical policies have card or deductibles. And then the common accident deductible. These are very rare, but they still seem to show up on a test sometime. So let's assume we have 2 people. They don't even know each other. They're insured by the same insurance company. They happen to both be in the same building when it collapses, and they both get injured. They go to the hospital. They got to pay their hospital bill. Well, the insurance company is going to only require that one deductible be met between the 2 of them. They'll work it out. So common accident deductible means there's only one deductible among all the insureds under that contract if it has common accident deductible per accident. One deductible per accident. Co-payments we've already talked about more than once. It's a set dollar amount you got to pay before the insurance company pays anything, right? It's kind of like your admission to get on the ride. Exclusions. An exclusion is an insurance company's excuse not to pay. Now, what seems to be more often that shows up on the test are the ones at the bottom. the ones at the bottom. Other. See, other. War, military duties, obviously, if a person's in the military, then the military is going to take care of them. I don't even know how someone in the military would get a private policy. So you can ignore that part. But the next four, self-inflicted. Insurance companies will never, ever pay if there's a self-inflicted injury. Must be accidental. So self-inflicted injuries are excluded. The next three, dental, cosmetic, and refractions. And when they speak about refractions, they're talking about eye surgery. There's a million different kinds of eye surgery. They just most of the time use the word refraction. Well, dental or cosmetic or refractive surgery will be covered under a policy if, big if, it's a medical requirement. It's maybe some traumatic event took place, horrible accident, disfigurement, but not if it's elective surgery. See, dental surgery, cosmetic surgery, and eye surgery that is elective surgery, you do it because you want to look prettier or more handsome, that's not covered. Elective surgery, dental, cosmetic, and refraction are excluded. And the care in government facilities works the same as military. URC or UCR. These are letters that refer to usual, customary, and reasonable. Usual, customary, and reasonable. And that was there it is. Usual, yeah, customary, and reasonable. There aren't too many policies that operate under this premise. This is the kind of policy that pays a benefit based upon, these are medical expense policies that pay a benefit based upon the usual, reasonable, and customary charges for that procedure in a given geographic area. Payment is based upon the average charge in a given geographic area. So the reason why I have the letters twisted around up at the top is that sometimes the test spells it out as usual, reasonable, and customary, and sometimes they spell it out as usual, customary, and reasonable. Means the same thing. Most policies have a schedule of benefit where you can look into the policy and it'll tell you, appendectomy, bang, you get so much money. They list it like a menu in a restaurant. They tell you what the item is and they tell you what it's going to cost you. But there are some policies that utilize usual, reasonable, and customary. Riders. We had a discussion about riders, how riders must sit on policies. Riders cannot have an independent life. Riders either are attached to an existing policy. Usually at the time you buy it, you add a rider to the policy. So one of the riders that you may get a test question about is called an impairment rider. And an impairment rider is a permanent exclusion. Yesterday we talked a little bit about temporary exclusions and permanent exclusion, and they have a look back period of 2 years for individual policies, 1 year for group, 6 months for Medicare and long-term care. And a company could temporarily exclude that condition for the same period of time they could look back. If you buy an individual policy and they find you have a pre-existing condition within the last 2 years, then they can temporarily exclude that condition from coverage, but for no more than 2 years. Or if it's group policy, it would be 1 year. And if it's long-term care and med sup, it could only be 6 months. But they also could do what? Permanently exclude the medical condition. This happens often with bad backs. So if it's a permanent exclusion, they're going to refer to that as an impairment rider. You see the word impairment rider, they're talking about a permanent as opposed to a temporary exclusion. Disability income policies also have a rider you can add. It's called the guaranteed insurability rider. It's also referred to as future increase option. It's a little different than the one we discussed with life insurance yesterday Remember the one that went from 25 to 40? This is a little different, but it's the same idea. Because you're allowed to, with this rider, if you have it, you can get more insurance later and you don't have to prove you're insurable. That's the whole idea behind the words guaranteed insurability or guaranteed future increase. So let's see what happens. Let's assume somebody is making $5,000 a month and they buy a disability income policy that's going to pay them $3,000 a month. And a few years down the road, they're now making $10,000 a month. Maybe they would like to, if they're smart, they should, increase that benefit from $3,000 to $6,000 so they have the same ratio of benefit to income. $3,000 to $5,000, $6,000 to $10,000. But if they're not insurable, insurance company's not going to do it. So adding this rider will allow the insured every couple of years, without having to prove they're insurable, increase their increase their disability income benefit. As long as their income has gone up, they can increase their benefit proportionally. Multiple indemnity rider. We talked a little bit about double indemnity yesterday, as I remember. Multiple indemnity rider is kind of similar, but it's tied to health insurance. You may run across a policy like a hospital indemnity policy. A hospital indemnity policy. This is health insurance. Hospital indemnity policy. Hospital indemnity policies pay a certain dollar amount per day for every day you're in the hospital. You can buy 100 a day, 200, whatever you can afford, you can have. And that policy pays no matter what else is paying. Your medical expense policy might pay some of your bill, but these dollars go into your pocket. Maybe they help you meet your copays or your deductibles, but it's your money. You get it. However, this policy might have a rider that says if you have to go to the hospital because of an accident, then they might double your benefit to $200 a day or triple your benefit from $200 to $600, whatever, double or triple the benefit if the need to go into the hospital was because there was an accident. That's what we mean by multiple indemnity. The benefit is doubled or tripled if there was an accident to put you in the hospital. Rights of renewability. Insurance policies, almost every this is a health insurance policy issue, ladies and gentlemen. I'll talk about life insurance in a minute. This is health insurance. Almost every health insurance policy that I know of that's sold in Virginia is the type that is guaranteed renewable. That means at the end of the term of the contract, the insurance company's got to renew you. Now, they may increase your premium, but they can only increase your premium if they increase the premium on the entire class you belong to, right? As we move from one age bracket to the next, or they may raise the premium on all men or all women. They just can't single one person out. Now, there are other what are called rights of renewability, the insurance company's right to renew or not renew the policy. This is about the insurance company's right to renew or not renew the policy, okay? Now, these others hardly exist in the real world, but they show up on the test, which is why we got to go through it. There are some policies out there that are called cancelable. Cancelable. A cancelable health insurance policy is one in which the insurance company at any time, for any reason, can cancel you. All they have to do is give you 5 days notice. They don't even exist, and if they did, anybody who bought one would be silly. Then we have what are called optionally renewable. What you're going to notice as we go through this list, every type makes it a little more difficult for the insurance company to get rid of you. So optionally renewable, the insurance company, at its option, when the premium comes due or a renewal date comes up, at its option, it might choose to not renew. They don't have to give you a reason, but they have the option whether they're going to renew you or not. They can only exercise that option when the premium comes due or when the official renewal date of the policy occurs. Again, these, I don't know any that exist. except on a test. Conditionally renewable. This is a little more difficult for the insurance company to get out of. Very similar to optionally, because they can only exercise the opportunity for them to not renew you when the premium comes due or renewal date, not any time like under cancelable. But now, with conditionally renewable, they must give you a specific reason or condition that was specified in the policy. And as we have said more than once, 99.9% of all health policies issued in Virginia are guaranteed renewable. All right? Got to renew it. They can increase the premium, but only by class. Then we have another one. It's almost as scarce as the others. It's called non-cancelable guaranteed renewable. And with non-cancelable guaranteed renewable, the insurance company can never increase the premium, ever. And when I took my test about 100 years ago, this stuff was on my test, and it seems to show up on the test today. They love to do it. Here's why. Guaranteed renewable, non-cancelable guaranteed renewable. And in a test environment, these get jumbled up in your head. So one of the ways I suggest you take a look at this is this. Non-can, can never. That's the only difference between guaranteed renewable and non-cancelable guaranteed renewable, is what is going to happen to the premium. So non-can can never increase premium. Non-can can never. That may help you remember if they give you all of that in a question and you're trying to sort it out. These don't even exist. Now, here's a question that might show up, though. When you look at these 5 types of renewability provisions, all things being equal, which of these policies might have the lower premium? I'm going to give you the answer. It's cancelable, because it's easier for the insurance company to get rid of you, so they don't have to charge you as much. And which one has the highest premium? Non-cancelable guaranteed renewable, because they can never increase the premium once you get it. So you may get a question that deals with which of these 5 has the highest or lowest premium. So now you know the answer. The lowest will be cancelable. The highest will be non-cancelable. All other things being equal. Then we have what's called period of time insurance. I want you to make a note. It's also referred to as blanket, B-L-A-N-K-E-T, blanket insurance. Now, here's why they call it blanket insurance. If you took a number of people and you covered them under a blanket and you look down on that blanket, it would be very difficult to identify each individual person. And a little bit earlier, I said that almost every insurance policy wants to have the names of those that are insured. Remember the named insureds? I said there's one exception. This is it. Under period of time or blanket policies, there is no requirement to individually identify each insured. Anybody covered under the policy, anybody under the blanket is covered. That's why they call it a blanket. And here's an example of how it might work. Let's assume I'm a scoutmaster, and I'm going to take a bunch of Boy Scouts on a camping trip next weekend. I don't know who's going to show up that day, but I better have some insurance in case one of those little kiddos gets hurt on my trip, because I don't want the parents to be asking me to pay their medical bills. So I find a company that sells this stuff and let them know what I want to do, and they're going to ask me a couple questions. Something like this. Where you going? When you leaving? When you coming home? And approximately how many are going to be there. They don't care who, they just want to know how many. So whoever shows up is covered. No need to individually identify each person. And when the trip is over, policy is not renewed. If I take another bunch of scouts out next weekend, I got to buy another policy. Schools use these very often when they take the children out on field trips. You may get a question about that. Period of time or blanket insurance is used when schools take kids out on field trips. Because we don't know who's showing up, but whoever shows up will be covered. Social insurance. We talked a little bit about social insurance. Medicare, Medicaid, Social Security. Medicare and Medicaid. Well, let's Let's drill down. Medicare, federal health insurance. It's a federal health insurance program primarily for people who are 65 and older. There are people who can get Medicare as early as 62 or even earlier, but primarily people 65 and older. Additionally, anybody who's on dialysis, it's called end-stage renal failure. If you're on dialysis, your kidneys are failing. Or if you have what is commonly called Lou Gehrig's disease, amyotrophic lateral sclerosis. Okay, that's a tongue twister, which is why I have ALS up there. But anyone who's been unfortunate enough to have either of those two conditions will automatically qualify for Medicare, and it doesn't matter what their age is. So remember, primarily for people 65 and older, but the next two doesn't matter how old they are. Additionally, anyone who's been collecting a Social Security disability check for 24 months will qualify for Medicare. It doesn't matter how old they are. So there are three groups of folks who can get Medicare, and it doesn't matter how old they are. Dialysis, Lou Gehrig's, SSDI for 24 months. Medicaid, on the other hand, is health insurance for people who are poor. But state and federal funds, I think we talked about it. It's a state program managed by the states, but the feds throw some money in the pot. But not anybody can get Medicaid. Basically, you got to be poor. Not bad folks, just folks having tough times. AFDC is an old program. I don't even think it exists anymore. It's aid to families with dependent children. Matter of fact, I probably ought to get rid of that because it's not even a program anymore. I can't do it. I'll do it later. Medicare. Let's talk more about Medicare. You don't need to know a lot about Medicare. There are not a ton of questions about it. So here we go. Medicare has 4 parts. There's 4 parts of Medicare. Part A helps those on Medicare pay their hospital bill. I didn't say it pays the bill, said it helps pay the bill. But it's automatic and mandatory for everybody 65 and older. Warren Buffett is on Medicare. Bill Gates will be on Medicare. So the richest people in America will be on Medicare when they turn 65. And the poorest people in America can be on Medicare when they turn 65. Because all it is you have worked, you're 65 and older, automatic and mandatory. Now be careful on the test. Medicare Part A is not free, but there's no additional premium. We pay for it from the taxes that come out of our paychecks that I think we talked about. The 2.9%, we pay half, the employer pays half. So there's no additional premium. Big difference between free and no additional premium. So it's not free. Part B helps pay the doctor. It's referred to as medical insurance. Part B helps pay the medical insurance, doctor bills. It's optional, additional premium. So Part A is automatic and mandatory. Part B, if you want it, you have to ask for it. Costs you extra money. Don't worry about the premium. They're not going to ask you about that. So now there's a few things I got to talk about here. I want to lay down some foundational issues when it comes to Medicare. Medicare, if somebody's on Medicare and they go to a hospital or a doctor, they have this little red, white, and blue card. It's like their Medicare card. And let's use the doctor. It's easier for me to explain it to you using a doctor. So they go to the doc, they're on Medicare, and they hand the doc that little red, white, and blue Medicare card. And then once the doctor is done treating them, the doctor is going to bill Medicare. The doctor's going to bill Medicare. Here's what happens. When Medicare asks doctors to participate in the system, Medicare system, but some doctors choose to be what are called non-participating. So what we need to talk about here is the difference between a participating physician and a non-participating physician. Participating and non-participating. Let me get down to the page. Okay. Boy, you can tell I'm not a very good typist. Okay. So what's the difference? Now let me tell you, use a story. I like stories. I think they help explain things better. So let's assume mother is on Medicare. She goes to the doctor, and the doctor is a participating physician. What that means is the doctor has agreed to accept Medicare, what they refer to as approved charge, as full payment. And the non-participating physician has not. I'm just going to put right here, has not. So now let's assume mother's gone to the doctor. The doctor's a participating physician. And let's assume the bill for that visit is $125. And the doctor's going to submit the bill to Medicare, because that's what happens. The doctor has to submit the bill to Medicare, and the doctor will get reimbursed, but not necessarily the whole amount. The Medicare is going to look at what was done during the visit, and Medicare might say, your bill might be $100, but we're only going to approve $100. That's our approved charge for the care you gave that patient. So here's what will happen. Medicare is going to send the doctor $80. And the beneficiary, that's what we call people on Medicare, the beneficiary is going to have to pay $20. Well, what about the other $25? What happens to it? Well, the doctor effectively has to write it off. They have to eat it. Because the doctor has agreed to accept Medicare's approved charge as full payment, they may not, what we call excess bill the patient. Can't send the patient for a bill for the extra $25. That's the way that works. Now, if mother goes to a non-participating physician, everything would be identical, except that the non-participating physician may excess bill, send mother the bill for the $25 that Medicare didn't pay. So obviously it's better to go to a participating physician than a non-participating physician. That's how Medicare works. And if you go to the hospital, it's similar, but it's easier to explain it working with doctors. So medical insurance is optional additional premium. Part A and B is referred to as traditional Medicare. So someone who has A and B, we say they have traditional Medicare. A and B, traditional Medicare. Now, Medicare doesn't pay the entire bill. We've already seen that. And when you're going to find out when it comes to the hospital bill, it gets expensive. Medicare beneficiaries have out-of-pocket expenses. Medicare, as a matter of fact, I should put this down here. So you can jot it down. Medicare has deductibles that the beneficiary has to pay, copays that the beneficiary has to pay, and coinsurance in many cases. So Medicare has deductibles, coinsurance, and copayments. Those are referred to as gaps in Medicare coverage. Gaps in Medicare coverage. Medicare doesn't pay the entire bill. That's why I was being very specific about it. Helps pay the bill, doesn't pay the bill. Helps pay the bill. So for people who are in traditional Medicare, they have these deductibles, coinsurance, and copays they're going to have to pay for, and that can get expensive. So what some people do, some beneficiaries do, they will go to a private insurance company like Humana, Aetna, Blue Cross Blue Shield, and they will purchase what's called a Medicare supplement policy. Medicare supplement policy. And a Medicare supplement policy, you may get a question about on the test, what is a Medicare supplement policy? Medicare supplement policies pay some or all of Medicare. So Medicare supplement policies pay some or all of Medicare deductibles, coinsurance, and copays. I'm anal here, so let me get this right. So Medicare supplement policies are also referred to as Medigap policies. Medigap policies. I just give you the words, so if they give you use the words on the test, I want you to make sure you recognize it to some extent. So Medigap policies are sold by private insurance companies to pay some or all of Medicare deductibles, coinsurance, and copayments. There's a premium you have to pay for those. They're not free. And they're sold by private insurance companies. And all Medigap policies are identified by a letter. They have a letter designation. A, B, C, F, G. There's a number of them. You don't need to know the numbers. But all Medicare supplement policies pay some or all of Medicare deductibles and copayments. But some pay more than others. Different policies have different benefits. But here's a test question. All Medicare supplement policies, oops, let me change the word, are standardized. Every Medicare supplement policy with the same letter is identical to any other Medicare supplement policy with the same letter. So we may have 10 insurance companies all selling a Medicare supplement policy, Plan G. Well, they are identical in benefits. The benefits have to be the same no matter what company is selling it. The only difference among those policies of the same letter is the premium somebody pays. That's the only difference. There is no difference among the benefits. Only the premium is different. That could be a test question. Medicare supplement policies are standardized. Every Medicare supplement policy of the same letter has to provide the exact same benefits. The only difference among the plans of the same letter is the premium you pay. Now, Medicare supplement policies pay after Medicare pays. So what happens, mother goes to the doctor. She gives her doctor her little red, white, and blue Medicare card. Doctor is going to bill Medicare. Medicare is going to give him some money back, probably not all of it. Remember the approved charge. But if she also handed him a Medicare supplement policy card from a Medicare supplement policy, now he's going to bill that private insurance company and most likely get the rest of the money. So mother doesn't have to come up with the excess copays and deductibles. Give you an example how valuable these are. These are powerful and awesome products. About 5 or 6 years ago, I was diagnosed with prostate cancer. I had a Medicare supplement policy, Plan F actually, as in Frank. And I had to get treatment. I went to a place called Hampton University Proton Institute. You may have heard of them. They're advertising on TV now. And boy, I tell you what, ladies and gentlemen, if you ever have anyone that you love or know or care about that's diagnosed with cancer, they better get a second opinion from this organization because they're powerful. Not many physicians refer people to them because doctors have a tendency to refer people to the organizations and hospitals they belong to. That's not necessarily the best situation. So I'm very hot on what's called HUPTI, H-U-P-T-I, because I had 44 treatments. I went every day for 44 days other than weekends and had treatment. I didn't lose a day's work. I didn't lose a hair off my head. I never got sick. I didn't even know I was being treated, except for some discomfort while I was there, not much. I'm not going to get into that, but it wasn't a big deal. And the bill was $250,000. Well, Medicare didn't pay that whole bill. But between Medicare and my Medicare supplement policy, I didn't have a dime to pay. I paid nothing because I had insurance to protect myself against that extra loss. So Medicare supplement policies are powerful, properly used. Premiums are not exceptionally high. And getting the proper treatment, I have a soft spot in my heart for Medicare, for HUPTI, because they basically saved my life. So every class, I talk about them. So if you ever know anyone who's been diagnosed with cancer of any kind, it's wise, my opinion, to get a second opinion from those guys. They may not be able to help. They won't blow smoke up your butt. But if they can help, you need to consider it, because I did, and I'm glad I did. Anyway, moving on. Part A, Part B. Now, not everybody can afford Medicare supplement policies. Those premiums start at about $100 a month. And every year as you get older, the premium goes up. Okay? So different policy, one company might charge $96, another card might charge $103 for the same policy, but every year the policy premium is going up. So what some people do is they opt out, OPT, opt out of traditional Medicare. I didn't say they opted out of Medicare. I say they opted out of traditional Medicare, and they opt into what is called the managed care benefits of Medicare. It's called Part C. Part C. It's also referred to as Medicare Advantage. Medicare Advantage is synonymous with Part C, which is synonymous with managed care. They all mean the same thing. They may use any of those terms to talk about an individual who is on Medicare but does not get a Medicare supplement policy but opts out of traditional Medicare and buys this Medicare Advantage plan. Medicare Advantage plans are also offered by private insurance companies. And these policies must be approved by Health and Human Services, Medicare. And they cover all of A and B benefits. So what I'm trying to say to you here, ladies and gentlemen, is this. And where's the questions? I want to just focus on the questions. I don't want you to become an expert in Medicare. That's not necessary. But Part A and B has some significant benefits. But if a person opts out of traditional Medicare and opts into Medicare Advantage, they're still in Medicare. That's one of the questions you may get. and they're still going to get their A and B benefits. But I want you to think about this. They're now in a managed care plan. Well, we talked about managed care plans. You may not remember this. Oops. May not remember this. Come on, Lou. May not remember this, but we talked about HMO. We talked about PPO. Those are managed care plans. So these are private insurance policies sold by private companies that are effectively HMOs and PPOs. And remember the attributes of HMOs and PPOs. HMO, the doctor gets paid a capitation fee. We talked about that. With a PPO, the doctor's paid a fee for service. I hope you remember that. And remember, there are networks with both HMOs and PPOs. So the questions you may get about managed care plans, Medicare Advantage, managed care, HMO, PPO, Part C, they all mean the same thing. They're nothing more than HMOs. So whatever you know about HMOs and PPOs will serve you very well to get answers when they're relating it to a Medicare Advantage plan. That's all there is to it. Then there's Part D for David. Part D helps people pay for their self-administered prescription drugs. Self-administered prescription drugs. Self-administered. So if you go to a hospital, if you're on Medicare and go to the hospital, Part A is picking up a part of the tab, which will include prescription drugs. Those are not self-administered. They're given to you by the personnel at the hospital. If you go to the doctor to get medical care, Part B pays your doctor. And if the doctor gives you a shot or doses you medication, that's covered under Part B. I'm just going to write meds, covered under Part B. But if you get a prescription to take to a drugstore to get filled, now you may already know this, but I can't take a chance that you don't get it. That's self-administered. I want you to write this down. Medicare. Medicare does not pay anything, not a nickel, not a penny, towards self-administered prescription drugs. Now, that sounds to be contradictory to what we've been talking about, but follow me. Self-administered prescription drugs, Part D, does cover them. But Part D doesn't mean that Medicare is going to pay for the drugs. With Part D, these policies are sold by private insurance companies. These are insurance policies sold by private insurance companies to assist beneficiaries I think that's spelled right. Beneficiaries in paying for self-administered prescription drugs. So Medicare pays, stay with me, I just want to make this clear. Medicare Part A helps pay for your hospital bill. They write checks to hospitals. Medicare Part B helps pay your doctor bill. They write checks to the doctor. The doctors and hospitals bill Medicare, and Medicare writes checks to the doctors and hospitals. Medicare does not write checks to the drugstore to help pay for your prescription drugs. Medicare doesn't do any of that. So therefore, we say Medicare does not pay for any prescription drugs. Self-administered prescription drugs, pardon me. So the only way to get that done would be to buy a policy of insurance from a private insurance company called a prescription drug plan, PRC, prescription drug plan. They abbreviate them sometimes PDP. That's a policy of insurance sold by a private insurance company that helps senior citizens pay for self-administered prescription drugs. That gets a little weird, but I hope I'm trying to make this as clear as I can. Medicare pays absolutely zero, zip, nada, nothing towards self-administered prescription drugs. If a senior citizen, a beneficiary on Medicare, wants assistance in helping them pay for their self-administered prescription drugs, they're going to have to buy a private policy of insurance called a prescription drug plan from a private company. That's how they get the help. That's what you need to know. So I'm not going to spend a lot of time on how it works, but I need to give you a visual. So hospital insurance only pays if you go to the hospital, inpatient hospital care. And then it'll also pay for inpatient skilled nursing. If her mother falls and breaks her hip, she has to have a new hip. She goes to the hospital for the operation. And then once she gets discharged, very often they send her to a skilled nursing facility so she can learn how to walk again. So Medicare will help pick up some or all of that bill. Medicare also has a home health care benefit. We'll talk about that again briefly. It has a hospice care benefit. I want you to make a note. Hospice is a plan of treatment, not a place. Hospice is a plan of treatment, not a place. Hospice can be provided at someone's home, in a nursing home, in a special section of a hospital. But hospice is not a place. It's a plan of treatment. And Medicare Part A has what's called a hospice benefit. So let's briefly talk about hospital insurance. How do we qualify? This is a little recap. So you got to be a citizen or have a legitimate green card. And you got to be, 65 or older? You can eliminate based upon 62-year-old spouse. I need to get rid of that. And I'm having so much trouble with my slides, I'm not going to mess with it today. So to qualify, citizen or legal resident, 65 or older, period. Cross the rest off. It's true, but it's not going to be on your test, and it's just too much to explain. Those that are under 65, we already talked about it. Anybody who's collecting an SSDI check for 24 months or end-stage renal failure or Lou Gehrig's disease. That's a recap of what we talked about. So how does it work? Well, Part A is not like anything you will ever encounter in the world of medical expense insurance. It works on a benefit period. Most medical expense policies work on an annual basis. Not Medicare Part A, it's a benefit period. So take a look at what it says. A benefit period begins when you're admitted to a hospital. And it ends when you've been discharged for 60 consecutive days. So if a person is admitted to a hospital, doesn't matter how long they're there, if they get discharged and go back in within 60 days, they're in the same benefit period. So theoretically, someone could be in and out, in and out, in and out, in and out of a hospital and never leave their benefit period, because it begins when you're admitted, but it doesn't end until you've been discharged for 60 consecutive days. That becomes a challenge for some people in their minds, but I think you'll get this. So what happens? Well, rather than give you this picture, let me go to the next slide. It's more visual for you. So here's what happens. Let's assume mother falls and breaks her hip. My poor mother, I take her through the ringer, okay? Mother falls and breaks her hip. She's got to go to the hospital. So if you'll notice, Medicare is broken into 3 segments. The first 60 days, the next 30 days, and the next 60 days. And as long as they're not out of the hospital for more than 60 consecutive days between these, it's all part of the same benefit period. So let's go. So mother's fallen and break her hip. She's got to go to the hospital, needs an operation. Medicare will pay 100% of the hospital bill for the first 60 days of the benefit period once she pays her deductible. So Medicare has a benefit period deductible. Now we talk about annual and common deductibles and all those other types of deductibles. Well, Medicare has a benefit period deductible. Don't worry about the number. You're not going to be asked that number. That number changes all the time. So Medicare will pay 100% of the hospital bill for the first 60 days of a benefit period, except for the deductible, and it doesn't pay for TVs, telephones, and private duty nurses. Now, hospitals have gotten smart to that part because most hospitals do not charge separately for TVs, telephones. So they incorporate it in the room bill. They still get paid. But just be aware, no Medicare benefit for TVs, telephones, or private duty nurses. So mother had fallen and broken her hip. She went into the hospital. She paid the deductible. And let's assume she had some real complications as a result of that hip surgery. And she had to lay there for 60 days. And they finally get her infections and whatever under control, and they discharge her. Now, normally they send her to a nursing home, but right now, let's just say she went home. And 2 weeks after she's home, she comes down with pneumonia. Well, she has not been home for 60 consecutive days. So we have some good news and some bad news. The good news is she's in the same benefit period, so she doesn't have to pay the benefit period deductible. But she's in phase 2, and that phase 2 will last for 30 days. And Medicare is going to pay a part of the bill, but the beneficiary must make a copay. And in 2009, it was like $267 a day. In 2017, it's close to $325 a day. So I don't know how many people you know that can afford $300 a day for 30 days, but that's a lot of money. That's where Medicare supplement policies step up because they have to pick up that extra. But anyway, moving on. So mother has some problems with her pneumonia. They can't get it under control. And after 30 days, they finally are able to discharge her and they send her home again. And wouldn't you know it, 2 weeks later, she falls down the stairs and breaks her hip again, her other hip. Well, she still hasn't been home for 60 consecutive days. So she's still in the same benefit period, but now she's really in the soup. Because for the next 60 days of the benefit period, these last 60 days are referred to as lifetime reserve days. In other words, you only get to use them once over your lifetime. I'll cover that in a minute. But any time, now mother's in the hospital, she's starting to use up these lifetime reserve days. And her copay is going to double what it was over here. So if she was paying $325 here, it's going to be $650 a day here. That's nuts. Medicare sucks. So what have I been trying to point out to you? Medicare Part A operates on a benefit period. After 150 days, the benefit period ends. The maximum length of a benefit period is 150 days, and Medicare then pays nothing. But remember, a benefit period doesn't have to end because what? You could technically be in your benefit period your whole life. If you're in and out of the hospital enough times without a break of 60 consecutive days, you're in the same benefit period. So you blow through those 150 days, and Medicare is not paying anything. Because frankly, ladies and gentlemen, nobody lays in a hospital bed for 150 days. But a lot of senior citizens are in and out and in and out and are burning up those days because they're never home for 60 consecutive days. And at some point, they're going to run out. So what are the things you need to remember about Part A? The maximum benefit period is 150 days. There's a benefit period deductible. Medicare pays 100% of the bill for the first 60 days of the benefit period, except for TVs, phones, and private duty nurses. And then for the next 30 days and the next 60 days, mother has to make a copay. But once mother's burned up her 150 days, Medicare doesn't pay anything. That's effectively what you got to know. Medicare also has what's called a skilled nursing benefit. A skilled nursing benefit. So, of course, when mother was discharged from the hospital with that broken hip, they probably would have sent her to a skilled nursing facility. I use the term go home just to make my example work. But she would have probably gone to a nursing home so she could learn how to walk again. So here are the things you need to know about the Medicare nursing home benefit, the skilled nursing benefit. It's a maximum of 100 days per benefit period. The first 20 days, Medicare pays 100% of the skilled nursing care bill. And the next 80 days, mother has to make a copay. Again, the dollar amount is not important. Just know there's a copay, and it goes up. It's close to $150 a day now. So we have a hospital benefit and a skilled nursing benefit. They're different, but they're tied together in that benefit period. Now, here's a caveat that they may give you on a test. For a skilled nursing benefit to be a benefit to a beneficiary, the beneficiary, must have been in a hospital at least 3 consecutive days somewhere in the last 30. If the doctor says mom needs to go to the nursing home, skilled nursing facility, and she has not been in the hospital for at least 3 days in the last 30, they're going to have to take her to the hospital, admit her, have her hang out for 3 days, and then transfer her, discharge her, and transfer her to the skilled nursing facility. That's government efficiency at work. Okay? But you need to know that little caveat about the 3 day and last 30. And the 100 days total, 20 in full. Medicare also has a home health care benefit. Now, this is a very generous benefit. Unlimited number of visits. And we talked about long-term care. We talked about home health care benefits. Well, those benefits are available under Medicare. Unlimited number of visits. Now, these are not mother-in-law type visits where they come and they never go home. This is a visit where a medical practitioner comes in, a nurse or an RN or an LPN, somebody, and they do something medically necessary and then they leave. But an unlimited type of those visits. But those visits must be provided by a Medicare-approved home health care agency. You can't call up your sister-in-law who's a nurse and expect Medicare to pay for it. They can only be paid for if it's done by a Medicare-approved home health care agency. Part A also has a hospice benefit. A hospice is a place where people go to die. Their doctor has said that they're terminally ill. Remember, hospice, I shouldn't have said it the way I said it, because hospice is not a place. Hospital is a plan of treatment. And there's the treatment. Anyone on Medicare that's receiving hospice is receiving drugs to help relieve pain and suffering. That's its primary function. Now, this benefit, hospice benefit, also, just like long-term care policies, this particular benefit under Medicare has a respite care benefit for the family caregiver. It allows the caregiver, who's a loving family member, to take a break. And the family caregiver could drop somebody off, mom or dad off at a facility, because a hospice can be in a facility, but it doesn't have to be. Or the Medicare will pay to bring a nurse in while the main caregiver takes a 3 or 4 day break. So respite care is for the caregiver, not for the patient. The patient never gets a break. Part B, medical, optional additional premium. Remember, it pays for the doctor. Now, Medicare Part B is a lot more like typical health insurance that we may be used, medical expense insurance that we may be used to. There's an annual deductible. Remember, Part A had a benefit period deductible, how convoluted it was? Well, Medicare Part B is real simple. There's an annual deductible. You don't need to know the number. Again, I just give it to you to have a point of reference. But once the Medicare beneficiary has been to the doctor and spent the deductible amount out of pocket, then Medicare will cover 80% of the approved charge. Remember, we discussed that when I went to my little worksheet. And the patient has to pay the 20% coinsurance. And there's no out-of-pocket limit on the beneficiary's coinsurance. And that's only if they go to a participating physician. If they go to a non-participating physician, they not only have the max of the 20% out of pocket with no limit, but they also may have to pay excess charges. So most Medicare beneficiaries go to participating physicians. And then again, as I said, Part B will pay for prescription drugs, but only if administered by the doctor. A and B is to remind me to remind you that applies to both Part A and Part B. So remember, if they're administered by a physician or hospital personnel, that's not self-administered. So the A or B will pay for it. Medicare Advantage, quick recap. These are managed care plans. Remember, managed care plans, HMOs and PPO types. They're purchased from where? private insurance companies? Are they still in Medicare? Yes. So why do people do that? Well, the premiums are generally real cheap. I mean, really cheap. I do a lot of Medicare Advantage plans with a lot of senior citizens. It's one of the major things I do in my insurance practice. And I've got some Medicare Advantage plans available in some zip codes where the premium is zero premium. If they go to the doctor, they have a $15 copay, not a 20%. If they go to a specialist, they might have to pay a $45 copay. So it's a lot easier for the senior citizen to budget their health care costs, which is what the test talks about. Why would somebody opt into Medicare Advantage as opposed to a Medicare Summit policies? Well, Medicare Summit policies can be expensive for many senior citizens on a fixed income. I'm blessed that I can afford what I have, but not every senior citizen has that blessing. So they find it easier to budget their health care costs by buying Medicare Advantage. And even above and beyond that, for those people who are old and broke, Medi-Medi, they're on Medicare, old, they're on Medicaid, broke. Even if there is some premium or some copays, Medicaid will help pick up some of those bills. So there's a great affinity with senior citizens in these products. They love them. Most senior citizens love them. And the Part D prescription drug plans, just to recap, private insurance companies, optional. Make a note, however, if somebody doesn't buy it when they're supposed to, that's within 6 months of enrolling in Part B. Just know it. It's within 6 months of enrolling in Part B. That's when they need to buy it. If they don't buy their prescription drug plan within 6 months of enrolling in Part B, then they're going to have to pay a 1% penalty for every month that they're late. 1% of what, I'm asked? 1% of the average monthly premium for prescription drug plans, national average. The national average is about $35. 1% of $35 is 35 cents. Doesn't sound like a lot of money. But many senior citizens wait years, like 5 years. That's 60 months. Multiply 60 months times 35 cents. Now you're paying another $18 a month. It's crazy. But anyway, 1% penalty if they're late. They have to be in Medicare. Don't worry about that, not on the test. Don't worry about that, not on the test. Now, think about this. Are there people 65 and older who are still working and maybe they have group insurance at work? The answer should be yes. If they have group insurance at work, remember, their Part A is automatic and mandatory because they turn 65. So now they have two policies of insurance, one from Medicare and one from the employer. Well, they're both not going to pay at the same time. So the question becomes, if there is someone who's 65 or older and still working, covered by a group plan, which policy is going to be the primary payer? The group plan at work is the primary and Medicare is the secondary. Group plan at work is primary, Medicare is secondary. What the hell just happened? God. The employer cannot offer any incentive for the beneficiary to drop the group plan. Why do I have that there? Because you need to know it. You see, the senior citizen, if they're on Medicare, can choose if they want to drop the group plan at work. We don't generally recommend it, but they could. But the employer cannot offer the old guy or gal an incentive to drop that group plan. That's the question. So Medicare Summit policies, as we said, are also called Medigap. They pay some or all of Medicare deductibles, coinsurance, and copays. They're offered by private insurance companies. They have to be standardized. The standards are set by National Association of Insurance Commissioners. I believe we talked about those folks. 55 egomaniacs who run the various bureaus of insurance across the country. They're all in charge of their own little state department or bureau of insurance. So they got together and created these standards for Medicare supplement policies. Now, Medicare supplement policies do not fall under the Affordable Care Act. Therefore, anybody who wants a Medicare supplement policy has to qualify medically. They have to take not a medical exam, but they have to answer medical questions, and they might not qualify because of a medical condition. However, there is a special rule, and you may need to know about the special rule. Any senior citizen, 65 or older, can buy a Medicare supplement policy without regard to their health if they buy it within 6 months of enrolling in Part B. Matter of fact, I'm going to fix this right now. Now that's better. So there's a special provision, maybe a test. There are no medical requirements to buy a Medicare supplement policy if the beneficiary buys the Med Supp within 6 months of enrolling in Part B. Guaranteed to be issued. They could be laying in a hospital bed dying of cancer. And within 6 months of enrolling in Part B, remember Part B is optional. So when they enroll in Part B, then a window opens. Keep it, visualize that. A window opens, stays open for 6 months. That gives them the opportunity to buy a Med Supp policy from any company that offers it in the state. And they can't charge them extra money because they got a medical condition. They got to cover them immediately. That's a great situation. Not a great situation, but the fact that they can get it without medical requirements, that's a good thing. And the plans, as we said, are by letters, right? Different letters. You don't need to know any of this. This is when I have time to discuss it. If you want to know more about it, we'll talk about it. But on that list, what I need you to know is right here. Medicare Part A and Part B have a 3-pint blood deductible. 3-pint blood deductible. If someone's on Medicare and they need blood, they got to pay for the first 3 pints. Medicaid, as we have said, federal and state funding, typically people who are poor, right? Now, make sure you get this distinction clear. Medicaid will pay for the long-term care needs of someone on Medicaid, but Medicare pays 0 towards long-term care. Medicare doesn't pay anything towards long-term care. The only nursing home care Medicare pays for is 100 days per benefit period, and that's not very long. So you have to make sure you read the question carefully. The words sometimes run together, huh? So Medicaid will cover long-term care insurance. Now, this poor person, if they need help with the assistance of daily living, are going to have to go to a nursing home. They can't stay home. They're not going to send somebody to take care of you. That's too expensive. Go to a nursing home. So will Medicaid cover long-term care? Yeah, but they have to go to a nursing home. Medicare does not. Somebody give me a reminder here. I'm going to need a little help with you guys. Did we discuss how somebody qualifies for a Social Security disability benefit? Does any of that look familiar to you? Anybody?
No.
Okay, well, we'll talk about it. It's good. Now, we talked about Social Security disability, SDI, and we also said that someone who's collecting a Social Security disability check for 24 months qualifies for Medicare. So you may get questions about how does somebody qualify to get a Social Security disability check? Well, it's not easy. It's a very restrictive definition. First step, they have to be fully insured. What does that mean in English? Oh, I just noticed a misprint. What does that mean in English? What that means in English, they have to have earned enough money in 40 calendar quarters over their lifetime. So we just abbreviate it. 40 quarters over a lifetime. That's not 40 25-cent pieces, right? That's 40 quarters over a lifetime. Then they're called fully insured. They've just cleared the first hurdle. Second hurdle, they have to be classified as disability insured. So when they apply to get their SSDI benefits, the Social Security Administration is going to look back over the last 10 years of their working life, and they're going to make sure you have earned at least 20 of the last 40 quarters. Those are pretty easy. Most people can qualify. As a matter of fact, they're even adjusted for age. We're going to cover that in a minute. Because there are sometimes people are so young, they haven't been working long enough to qualify, but they still are really badly off. So we'll talk about that. But here's the killer. This is what knocks most people out of the box. We have to be unable to perform any job that exists in the national economy. Well, that's pretty severe. If you're a neurosurgeon and the Social Security Administration thinks you can make $500 a month flipping burgers at McDonald's, you're going to work at McDonald's. Okay, you're not getting a Social Security disability check. So it's very restrictive, okay? In addition to that, to add to the restriction, the disability must be the type that will last at least a year or kill you. So we're not talking about broken arms. So should a person be fortunate, if you want to call it that, qualify, once they get qualified, Social Security says, all right, you're qualified. And the beneficiary says, great, when am I going to get some money? Well, you got a 5-month waiting period. Can't get a check for 5 months. You'll get a check in the 6th month, and it's not retroactive for the 5. Now, I used to wonder why they did that. Here's why. This is really cold, but this is why they did that. They did a study, and they found out that people who met the criteria to get Social Security disability, many of them died within 5 months, so they never had to pay them a benefit. So I know that sounds cold, but that's what that's their reasoning. Isn't that amazing? Government. All right. So you need to kind of be aware of those. I don't think you need to memorize them, but you should be aware of them. It's a very restrictive definition. Now, 24 months from where? 24 months from right here, they're going to be qualifying for Medicare. Now, got to watch this question on the test. I said that there were 2 of those provisions that were adjusted for age. So if someone is too young to have earned 40 quarters, it's adjusted for age. What I want to focus on is this chart, and you probably have it in your slides. So let's take a look at ages 31 to 42. So anyone between the ages of 31 to 42 who's applying for SSDI only needs 20 quarters of credits, not 40. Somebody who's 50 needs 28. Somebody who's 55, I know that's not on the list, but pay attention. Someone who's 55, they're going to need 33 quarters of credits. The chart is in 2-year increments, but obviously we live in 1 year at a time. Now here is where you got a little challenge. They may ask you a question. Mary is 53. How many quarters of credits will she need to qualify for SSDI? Well, they're not going to give you the chart. And I'm not so sure it could be memorized. Somebody might memorize it. I know I can't. But here's what I'm going to suggest you do. Memorize the starting point. Memorize this right here. 31 to 42 equals 20. When you sit down at the computer, they're going to give you some plastic to write on, a piece of plastic board or something to write on, and a marking pen. I would write down 31 to 42 equals 20. It's the first thing I'd do. And if I get the question similar to what I just explained to you, you should be able to count on your fingers to get the answer. I wouldn't wait until I saw the question, because by that time, your brain will be fried. You may not remember where to start. Just giving you a suggestion. Okay? Write down 31 to 42. equals 20. And that should help you should you get a question similar to what we've just gone over. PIA, what does that mean, PIA? Well, when I was younger, there was a singer. Her name was Pia Zadora, P-I-A-I-S. Well, I used to think that's what it meant when you talk about the singer. Well, it doesn't mean her. PIA stands for, here you see it, primary insurance amount. That's the dollar amount that they believe that you're going to be getting when you retire. That's the basis upon which you're going to get an SSDI check as well. It's a calculation based on how much you earned and how long you worked, etc. PIA, just know what the words mean. So it's a very restrictive definition. So it's already, I've duplicated it. Okay. Other health insurance concepts. We're going to break here in a minute, but let's finish up. Other health insurance concepts. Owner has all the rights. That's not new to you. You should already know that. Life insurance, health insurance, we're talking about health or life. That's a fact. Beneficiaries, we've already talked about revocable and irrevocable. There's nothing new there. So we're not going to spend a lot of time on that. Beneficiaries, I think we discussed the idea that anything capable of receiving money can be a beneficiary. No dogs, no trees, no cats, no rocks. Did we go over that in class? Anybody remember me talking about no dogs, no trees, no cats, no rocks? I think we did. Okay.
Yeah, we did.
Yeah, I thought so. Okay. So we're not going to go over that again. Modes of payment, we've already covered this, I think. It means frequency, how often you pay, right? With health insurance, you could pay weekly or monthly or quarterly or semi-annually or annually. Most of the time with life insurance, it's monthly, quarterly, semi-annually, and annually. But remember, the more frequently you pay, the more you pay by the end of the year. I believe we discussed that as well. Well, I don't think we talked about this, though. What's called coordination of benefits provision. This is a health insurance issue. Let's assume Daddy works for Company A. He's got group health insurance. His wife works for Company B. She has group health insurance. And they have decided that they would be willing to pay the extra premium so that they can become dependents on their spouse's policies. They can do that. So if Daddy or Mommy gets sick or hurt off the job, then their company policy will be the primary payer and their spouse policy will be the secondary payer. That's the way that works. But your question very often will be, what happens if baby is a dependent on both policies? Which policy is going to be the primary payer, dad or mom? Answer, whichever parent has a birthday first in the year, that's primary. That's called the birthday rule. Virginia uses the birthday rule. Whichever parent has a birthday first in the year. I didn't say who's oldest or youngest. I said whichever parent has a birthday first in the year. Dad was born in January. Mom was born in October. She could be younger than him. It doesn't matter. His birthday's in January, so his policy is going to be primary. Whichever birthday occurs first in the year. Some states, many states, use the gender rule, meaning dad's policy. But that's not the way it works in Virginia. Virginia uses the birthday rule. Now, most of us have our individual health insurance policies. Some of us have group insurance at work. So any individually owned health policy will cover off-the-job injuries. But here's the key. Anyone who's self-employed, they would have a policy, they call it occupational policy. Self-employed has an occupational policy. If we buy, I'm self-employed, you may be soon as well, you may already be. If you own a medical expense policy, that's going to be classified as an occupational policy. Why? Because it's going to cover you for injuries and illnesses that occur while you're working or not. Doesn't matter. Because you don't have workers' compensation to take care of your work-related illness and injuries. But if that exact same policy is owned by someone who works for a company, that policy is going to be called non-occupational. It's only going to cover off-the-job illnesses and injuries because someone who works for someone else has workers' compensation to provide for work-related illnesses and injuries. So there may be a question to try to confuse you between what they mean by occupational as opposed to non-occupational. So this is something you got to know. Occupational policies are primarily for self-employed, cover you 24 hours a day. Non-occupational policies will cover you for non-occupational illnesses and injuries. Tax treatment. I think we went over taxes. I'm not going to go back over them again. All right. I don't think we went over tax treatment for medical expense insurance, though. I think we did it for disability income insurance. Anybody remember? My head gets tired too. Anybody remember we did talk about taxes? Nobody remembers. Maybe we didn't. Okay. All right, let's talk about taxes. There may be one or two questions on the test about it. Medical expense insurance is treated differently than disability income insurance. The tax rules surrounding medical expense policies are different than the tax rules for disability income insurance. So here's what happens. We're first going to deal with medical expense. This may charge you, you may remember this, okay? Medical expense. The premium is always tax deductible, no matter who pays it. And the benefits, somebody collects a benefit under their medical expense policy, the benefits are always income tax free, period. But the question goes beyond that. Question may also ask, how much of the premium is tax deductible? How much of the premium is tax deductible? So, self-employed and employers who are paying premium for their employees, they get to deduct 100% of their premium from their taxes. Employees can only deduct the amount of premium plus unreimbursed medical expenses if they exceed 10% of their adjusted gross income. Sometimes you might see it abbreviated AGI. Now, you're not going to be asked to calculate it. You just need to recognize the term. So employees can only deduct premium plus any unreimbursed medical expenses. In other words, it's not covered by the policy. If that number exceeds 10% of their adjusted gross income. Senior citizens. '65 plus. It's exactly the same as employees, except it's 7.5% of their adjusted gross income. That's the only difference. Those are numbers you may see on the test concept here. Let's go to benefits. With benefits on any medical expense policy, no matter who pays it, the benefits are always what? Income tax free. You can take that one to the bank. Now, let's talk about disability income. Now the rules get a little bit complicated. They still want to know, is premium tax deductible and are benefits taxable? But here's what happens. And I'll try to give you a rule of thumb here. When the payer and receiver are the same, premium is not tax deductible. If they are different, then the payer gets a tax deduction. So let me give you an example. Let's assume you buy a disability income policy that in case you get disabled, it'll provide you some benefits, replace your income. You are the payer and you will be the receiver. Therefore, you don't get a tax deduction for the premium you paid. On the other hand, if you work for a company that has a disability income policy as part of your benefit and your employer is paying the premium, well, then the employer is going to get a tax deduction for the premium you paid. They paid, because the payer and the recipient are different there. So let's talk about benefits. Well, when the payer and the receiver are the same, then any benefit is tax-free. If they are different, then the benefit is taxable to the receiver. So if you buy your own disability income policy, that if you get disabled, you get a benefit, you're not getting a tax deduction for the premium, and should you get a benefit, you're not going to pay tax on it. But on the other hand, if your employer is paying the premium, they're getting a tax deduction. When you get the benefit, you pay tax on that benefit. So there's no way I could give that to you any more simple. Try to make a note and get a handle on it. There may be only one or two questions on the test. I wouldn't be overly concerned, but I know people want to get it right. And long-term care insurance is treated exactly like medical expense insurance. Long-term care, Medicare supplement, and medical expense insurance, taxes treated the same. Okay? And we've already gone through the tax treatment. But I'm going to give you an example here. This example may help pull it together for you. John has a disability income policy. His employer pays 75% of the premium. He pays 25%. He becomes disabled. The benefit's $1,000 a month. How much of that benefit is taxable? I'm going to give you the answer, then we're going to see how we got there. It's $750. Now, some of you may see it and some of you may not. So how do we get $750? We get $750 because 75% of the premium was paid by the employer. Therefore, 75% of the benefit's going to be taxed. If the question says the employer paid 100% of the premium, then the answer would be A. If the question says the employee pays 100% of the premium, then the answer would be D. I hope that makes sense to you, because that's the kind of question you may get on the test. If you can nail that one, you're going to be okay. Now, different insurance companies will define total disability differently. Some companies use what's called the own occupation definition, and some companies use the any occupation definition. So let's use a dentist. Let's assume we have somebody who's a dentist. They've gone to school, they've got a great education, they can do a lot of things, but they are a dentist. If their policy, their disability income policy, uses the own occupation definition, and if they become disabled, how do we define it? Being unable to perform any of the duties of your own occupation based upon education, training, experience, that guy can go get a job teaching at a university. His policy's got to pay because his own occupation was a dentist. Doesn't matter what he was trained for. What is the occupation when he got disabled? On the other hand, if his policy has the any occupation definition, then his policy's not going to pay, because it says what? We'll pay you a benefit if you're unable to perform any of the duties of any occupation based upon your education, training, or experience. So this one is a more restrictive definition. This one has a higher premium. Own occupation, all things being equal, own occupation will have the higher premium. The any occupation is the lower premium and more restrictive. Total disability. We've already talked about partial disability. We're not going to get into that. Not necessary. We've already talked about residual. I'm not going to go through that again. We've discussed it. Somehow I have this in my slides twice, but we went through this. We already talked about relapse. Not going to go through that again. I got to clean up my slides. They're making me crazy. But I make changes. Managed care, forget that. Workers' comp, I believe we talked about workers' comp, where the illness must arise out of in the course of employment. Worker can't, if we didn't, let's do it. Worker cannot sue to get benefits. Why? Because the law says they get your benefit. It's required that an employer have it. The employee doesn't have to prove somebody was at fault. They don't have to prove that somebody was at fault or negligent. They just have to prove it was work-related. Now, they may have to sue to prove it was work-related, but they don't have to prove to get the sue to get their benefits. 4 benefits under workers' comp. I think we talked about this, but see, I did an online class before the 2 days before I saw you, Thursday and Friday. So the reason I'm confused, I don't remember if I covered it in the online class or the live class with you. So forgive me, but hearing it twice isn't going to hurt you. So workers' comp has 4 benefits: medical without limit. Now, there's a limit, I promise you. But here's what we mean. If somebody needs a wrist brace because they have carpal tunnel or something, insurance company can't give you $10 and tell you to go to Walmart and buy an ACE bandage. They have to provide you whatever wrist brace you need to help you without regard to the cost. That's what they mean by without limit. Also, rehab, it says not 100%. May not be possible. Some person loses a limb on a work-related event. How the dickens do we get them 100% rehab? So it's not a requirement under workers' comp that they get 100% rehab. Because your test may be about what is required. Okay, it's not required to be 100% rehabilitated. Subrogation, I think we already talked about this, where you give up your right to sue. I talked about the auto accident. I'm positive I talked about this. So why is this slide there? This slide is to remind you why we started out with this Thursday night. Piles and piles and piles of Ben Franklins. I like George, but I prefer Ben in my wallet. Now, we're going to take a quick break. We're going to come back and do the law, and then we'll be done. So I'm going to we'll take a break about maybe 10, 15 minutes. My screen will come back. You'll see me back, and we'll go from there. My screen may stay on, but you'll know I'm back because you'll hear me hollering at you, okay? So just take about a 15-minute break, okay? See ya. So there's a lady that's the commissioner of the Bureau of Insurance. So one of the questions you may get is, how does a commissioner get to be the commissioner? Well, there's your answer. The commissioner is appointed by a 3-judge panel made up of members of the State Corporation Commission. That's it. She's not elected by the people. She's not selected by the governor. That's the answer to the question if you get it. How does a commissioner get to be the commissioner? As a commissioner, she has certain responsibilities. One is to execute the laws. Now, here's where people get into trouble if they're not careful. She does not enact, E-N-A-C-T. She doesn't enact the law. That's the legislature's job. She executes the law. So read the question. That's the point I'm making. She has the responsibility to license everybody who wants a license, and then she issues rules and regulations. She can issue any rule or regulation that she thinks is necessary. That's basically, she got carte blanche. She doesn't have to get anybody's approval or permission to issue a rule or regulation. Now, she has to have a hearing, but she doesn't have to listen to anybody. She can do whatever she wants. So you may get a question about her ability to issue rules and regulations. Any rule or regulation she thinks is necessary to execute the law. Now, you and I as agents have to keep records. We're required to keep records for 3 years. Either paper records, digital records, but we have to keep records of what, people ask me. Well, of your what you do, your copies of the applications, copies of correspondence that you have with your clients, paper or email. You need to have all that stuff. You either set up a file. I'm sure there are some managers there that will help you figure out how to do that, because we're required to have those records in case the commissioner asks us for them. So very simply, how long do you have to keep records? The answer is 3 years. Okay. Insurance companies also have to keep records. That's also 3 years. Now, insurance companies have to keep complaint records. They have to keep complaint records for 5 years. We don't have to worry about complaint records because we are not authorized to handle a complaint unless we get instructions from the insurance company. So anybody who's screaming at you over the phone, that's not a complaint. That's just somebody who's venting. Excuse me. But if you get something in writing, because a lot of times the complaint comes to an agent, if you get something in writing, you're required to pass that up the chain of command. And the insurance company ultimately, when they get it, are going to have to make a file and follow through on that complaint. And they may get a hold of you and ask you to handle it and tell you what they want you to do, but we don't act on our own initiative. So understand. Now, there's a type of long-term care policy called partnerships. Partnership plans are different than plain vanilla long-term care plans. Not a lot of stuff I need to tell you about it because it doesn't go that deep on the test. But what you need to know is advertisements. So a long-term care partnership advertisement, insurance companies got to keep that for 4 years. And those of us who have licenses have to get trained. We have training to do, continuing education, special courses to sell these quote-unquote partnership plans. Well, insurance companies have to keep training records for 5 years. Excuse me. So there's a lot of numbers up there. So what I've tried to do is break it down, make it very simple. If you get asked a question about record keeping, if you don't know the answer, 3 years is the answer. The only exception to the 3-year record keeping rule is long-term care partnership ads, 4, training and complaint records, 5. That's it. I think if you can get it that way, you'll have a lot easier time of picking out the right answer. So because records have to be kept, commissioners are required to make sure that's done. So one of the questions you're going to get is, what does she have to do? What does she have to do? That's the word shall. You know, there's no wiggle room with shall. So she's required to inspect the books and records of every admitted insurance company once every 5 years. She may inspect any record anytime. As a matter of fact, in your office up in Virginia Beach, the Virginia Beach office, right there just off the lobby is like a big long closet, and there's records, files kept in there. And if a commissioner or one of her people comes in and they want to see the records, they got to open that door and show them to her. They just can't say, come back tomorrow, we're busy. And the same for you. Now, I don't want you to panic because I've been in this business well over 50 years, and I, so far, knock wood, have never had anybody from the commissioner's office want to see my records. But I keep them. First of all, it's smart. You should keep records. It's good for your business. You should know what's been going on so you can follow through and follow up with people. But anyway, those are the bullet points you need to know. Now, you and I, as agents, are held responsible for our actions. If we mess up, we pay a penalty. So the commissioner has the authority to levy penalties on us. Now, one of the things I want to make sure you understand, I don't have that open anymore. Okay, no big deal. One of the things I want to make sure you understand is that any penalty that the commissioner levies on an agent is always going to be classified as a civil penalty, civil. If the commissioner suspects criminal activity, she has to refer that to the state attorney general because that's the AG's job. Okay? So that being said, they break penalties down into types. So anytime we intentionally violate any rule, regulation, law, or order of the commissioner, we could be fined $5,000 per violation. If we do it unintentionally, which means ignorance for us is not an excuse, if we do it unintentionally, then it drops to 1,000 with a cap of 10 for any series of similar violations. So you may get a question that asks you, what's the maximum penalty the commissioner can levy on us? The answer is 5,000, because that's the maximum penalty per violation. That's the question. Okay. And now, don't panic here. I mean, you follow the golden rule, do the right thing for people, do what you'd like to have done, and go to training and take notes and learn about the things you should and shouldn't do. The training sales are very helpful there. So you need to become a student of your business. Now, if somebody tries to sell insurance without a license, they can be penalized an amount of money equal to the first year commission. So that's just a throwaway test question. Got to have a license to sell this stuff. Somebody wants to make money selling insurance, they need to get a cotton picking license. If the commissioner feels that an agent is violating any rule, regulation, or order, she will issue a cease and desist order. Stop, don't do it again, right? Cease and desist. Now, she's got to give us 10 days notice to cease, okay? So you have to have time to stop what you're doing, and the 10 days gives you a chance to ask for a hearing. So she has to give you 10 days notice so you can have a hearing to explain what you're doing. Maybe she's wrong. Probably not, but that's the way that works. 10 days notice. So you're not out of business. Keep this in mind. If you get issued a cease and desist order, you're not out of business. You just have to stop doing what she tells you to stop doing. So you're not out of business. Just keep that in mind. Now, let me ask you a question. If an agent is issued a cease and desist order and says, the heck with you, Commissioner, I'm going to do it anyway, I think you would agree that would be a intentional violation. So here's the penalty. $5,000 and or loss of license and or 6 months. Now, that's not 6 months in Tahiti. The commissioner does have the authority to put an agent in jail. These are penalties that are civil, but still jail, okay? Now, again, don't panic. I have been in the business, I said, a long time. I have never personally known any agent who's ever lost their license or ever paid a major fine, any fine, as a matter of fact, let alone spend time in jail. Does it happen? Yeah. But these are the kind of people that play in traffic. You know, they want to push the envelope. Follow the golden rule. You're not going to have any problems. Now, the license you're going to get is called the Virginia Insurance Producer License. That producer license allows you to become an agent. When you get your license, you're going to see very clearly it says producer. You take that producer license, and then you would have to submit that to any of the companies that WFG represents or we work with WFG, and then those companies will appoint you to become their agent. So it's not an agent license. This is semantics, so pay attention, right? It's not an agent license. It's a producer license that allows you to get appointed to be an agent by an insurance company. Insurance companies cannot appoint anyone to be their agent. Whoever they appoint must have a producer license in the class or classes of insurance that they sell. So it's a producer license that allows you, obviously, to sell, solicit, or negotiate contracts. But look at that second one. It says receive, what's in red? Share commissions. You may get a question about this. Can you share commissions? Yes, but only with someone who has a license similar to yours. They don't have to work for the same company as you, but they have to have a license similar to yours. So if you have a friend that works for a totally different outfit and they have a life insurance license, and they call you up and they say, I got somebody that wants Transamerica and we don't sell it. I want to give you their name and number. And you say, great, give me the name and number. Well, I promise you what that person is going to say is, well, I'll give you the name and number, but we're going to enter into an agreement where you're going to pay me a percentage of your commission when you make the sale. You don't have to do that if you don't want to, but then he or she doesn't have to give you the name and number if they don't want it. So you can share, my point is, you can share commissions with anyone as long as they have a license similar to yours. They don't necessarily have to work for the same company as you. Also, someone with a state with a license from another jurisdiction, like North Carolina. North Carolina has a life and health license as well. That's not a license similar to yours because yours is Virginia. Make a note. If you haven't already written this down, I don't remember if I told you, but I want you to write this down in case you haven't. Insurance is regulated. Insurance is regulated primarily at the state level. Insurance is regulated primarily at the state level. So the states are the primary regulators of insurance. So you can share commissions with anybody who has a license similar to yours, but they must be licensed in the same jurisdiction you're licensed in. Now, the license you're going to get is a Virginia resident producer license, resident. Now, how do we know if you're a resident? Well, it's pretty easy, frankly. One, if your principal residence is in Virginia, that makes you qualified to be a Virginia resident. Or two, if you declare Virginia residency on your federal tax return. A lot of military personnel whose primary residence is another state who are here stationed and maybe file a tax return while they're here using a Virginia address for get the refund, that qualifies them. Or if you pay Virginia income tax. There are lots of military personnel who get part-time jobs, pay Virginia income tax. Or here's what helps most people. If your principal place of business is in Virginia, Now, I've got to make a point here to clarify. That does not apply to somebody who actually is living in California and wants to open up an office in Virginia. No. But there are two exceptions to this that make the last one work. If you're here in the military, your residence still may be somewhere else. But your principal place of business is going to be where? Here in Virginia. And you're going to be operating from Virginia. So that qualifies you. Or if you happen to live in one of the border cities. I don't know how familiar you are, but Virginia has, like Bristol, Virginia. Theoretically, I could live in Bristol, Tennessee, and right across the street, I could have an office in Bristol, Virginia. That's another exception. That's what I call border cities. There are a few cities in Virginia that do that. So the key for your test is principal residence, Virginia residency on a tax return, paying Virginia income tax, or if their principal place of business in Virginia. That qualifies almost anybody who wants to be a Virginia resident and get the Virginia resident license. Now, once you get your resident license, you may get a non-resident license in any other state. You don't have to take their test. All you have to do is go online. There's a place to go, a website. There's a couple of them. You fill out a form. You pay a fee. And within a week, you have a non-resident license issued from that other state using your Virginia resident license as the basis upon which to get that license. So there's a lot of reciprocity among states. You don't have to take a test in every state you want to get a license. All you have to do is use your home state license and get non-resident license in any other state. It's pretty cool. So the license you're going to get does not have an expiration date. So the term you may see is the license is perpetual. There's no expiration date on that license. It has an issue date, but no expiration date. So because of that, in the typical sense that we think about renewing, it doesn't renew. Like your driver's license has a specific date by which you must renew your driver's license. That's not the way it works in Virginia. Insurance license, because it doesn't have a renewal date, therefore you don't renew it. It only has an issue date. Semantics. However, And that's why this is why you have to read the question. Your license must be maintained. You must do certain things to keep your license. One of them is you must complete continuing education courses every 2 years. You can do these continuing education courses online. You can do them home study, or you can take live classes. Most of the time, if it's an online or home study course, it doesn't cost quite as much as doing a live class, but you're going to have to take and pass a closed book exam. And in some cases, they make you take a proctored closed book exam with somebody looking over your shoulder. If you go to a live class, even though it might cost a little bit more, there are no tests. Now, American Academy for Insurance Training is an approved provider for Virginia continuing education courses. So I'm just making a blatant bid for your business here. Mickey and I sit down every 2 years and work out a schedule that around September or so of every even numbered year, which is going to come up in 2018, we'll set up a schedule where on a couple of weekends we knock out the courses. We do them relatively inexpensive, and we have some fun along the way. You're not required to participate in my live classes. You can do them any way you like. Nobody's going to be mad at you. Nobody's going to dislike you, but that's available to you. They'll be announced. So what does it take to qualify to get a Virginia producer license? You got to be at least 18. I looked around the room when I was with you guys. I don't think anybody's under age 18. Got to be a resident. We've already discussed what it takes to be a resident. You have to pass a test. I mean, it would be nice if it just said take a test. You got to pass it with a 70% or better score in each section. Then once you pass the test, you must make written application to get your license within 183 days of passing the test. So passing the test does not give you your license. Passing the test gives you the opportunity to apply for the license. You can't apply for it until you pass the test. Now, nobody waits 183 days, but that's the deadline that may be on your test. Also, make a note, 183 days is approximately 6 months. So on the test, they may not say 183 days. Your only answer might be 6 months. That's fine. It's interchangeable. Or 180 days. So the number 180, 183, or 6 months for this purpose is the same answer. They're all interchangeable. Now, if you get a test question and you look at it, you see A, B, C, you see 180, 183, and 6 months, you probably need to read the question again because it's either going to be all the above or none of the above, because none of them is a better answer. They're all considered to be the same time frame. And as I said, I'm going to be sending you guys out an email with some instructions on how to do all of this. But if you haven't gotten by the way, your background check has to be started as well. I'm going to send you that instruction out as well. You need to get the background check started now. It's good for like 90 days. So get it started now because it takes upwards of 10 days to 2 weeks to get it. You don't want to wait till you pass the test and then get the background check. It'll be forever. As soon as you pass the test, you want to be able to go to work and start making some money. So don't get that delayed. We'll get you that information. The price to get your license is $15. That's the fee in Virginia. It's cheap, dirt cheap. New Jersey, it's like $350 every 2 years. California, it's closer to $400 every 2 years. So Virginia's cheap. There's no reason not to maintain your license. Background check is also going to cost you $15. So for a total of $30, which is tax deductible, you're good to go. Yeah, you've had some expenses, but you're going into business for yourself. Where the hell are you going to go into a business where to get the opportunity to work for a company, it costs you about $100, and your training is $150, and then you got to pay another $30 to get your licenses? That's cheap, especially for the potential. that exists in what you're going to do. Now, you may get a test question about a consultant license. A consultant, as you probably guess, is a person who gets paid to give advice. It's a separate license, separate test. But the test question revolves around this issue. Because you will be licensed with the Virginia Life, Health, and Annuity and Health License, you may act as a Virginia Life, Annuity, or Health consultant, and you don't have to take the additional test. But, big but, you can't do both. I don't know anyone who acts as a consultant. It sounds cool. I get paid to give advice. Most people don't pay for that kind of advice. When insurance agents will give that same advice for no charge because you can earn a commission. And the bigger money long term is in the commission, not in consulting. I don't know anybody who's a consultant. But you need to know that little fact, okay? Now, another question. Can a business get a license? Well, it'd be obvious a business can't take a test, so there must be a method for a business to get a license. For example, let's assume I want to set up a little agency. I want to have a name for it. I'm going to call it You Bring 'em, I Rip 'em Insurance Agency. Or Dewey Cheatham and Howe Insurance Agency. That's called a fictitious business name. Those are fictitious business names. And before I can use that name publicly, I must get approval from the state to make sure they want to make sure nobody else is using it. And then once I get approval to use that name, the state will allow me to get a license for my fictitious business name, which matches up to the exact same license I have. So agents, you got to have a license. A business to get a license to act as an agent gets the exact same license as the principal. So if you want companies to pay your business a commission, that business needs to be properly licensed. Now, some companies don't want to pay businesses commissions. That's their decision. But the question on the test is, can? Yeah, you can. That doesn't mean every company has to. And as I said, fictitious business names must be registered with the Commonwealth. Now, if you want to operate under your own name, Lou Crosati Insurance Agency, for example, that's my bona fide natural name. I don't need anybody's permission to use that. It's when we use a fictitious business name. Now, Virginia offers the opportunity under certain circumstances for people to get a temporary license. Temporary meaning 6 months, okay? It's only good for 6 months or 183 days or 180 days. There's no license test. There's no test required, but only certain circumstances. For example, you only get one per person per lifetime. You can't be getting continuing, keep getting new temporary licenses. No, sooner or later, you got to take a test. But one per person per lifetime. So if an agent dies, their spouse, next of kin, personal representative may immediately apply to the state to get a temporary license so they can continue to operate the business. And maybe find an agent to buy that book of business somewhere. Or take that time to get their own license. Okay. Same would be true if an agent becomes disabled, or if they're in the military and they get deployed overseas for a couple of years. It allows their spouse or next of kin, personal representative, to kind of step in for 6 months. That gives them 6 months to operate the business and 6 months to get a license, a permanent license they have to take the test for. There's no test required for temporary. Then there's another type, another group called debit agent. A debit agent is kind of like a bread route. One of my first insurance jobs, when I was in New Jersey, and I got a job with Prudential, and it was a debit. And by that we mean I got this big old book, and in that book were ledgers with names and addresses of people and places where I could mark down that I've collected premium on their policies, the policy numbers and all that stuff. And I went around door to door, knocking on doors once a month, collecting $3, $5 a month for policies that covered, like for burial, $5,000, $2,000, $1,000, $500. Debit agent. So one way to remember about who can have a temporary license, think about the 4 Ds: death, disability, deployment, and debit. death, disability, deployment, debit. Those are people who can get temporary license. But again, they're only good for 6 months, only one per person per lifetime. And if you want to last longer than that, then you got to take the test and get your permanent license. There are some exceptions. There are some people in the insurance business who do not need a license if they do not help others and do not help others make a decision about what to buy and earn a commission. Those are like customer service personnel, certain officers of the company. So you have to watch for that on the test. But if any question you get about do they need a license, if there's any thought in your part that that person is helping somebody make a decision about what to buy, and they're going to earn a commission for that, now you got to have a license. So rather than me go through a list of 600 things, that's the rule of thumb you should follow. Continuing education. This is important not only for your test, but for you to maintain your license. These are some numbers you got to know. The Virginia operates on what's called the even-numbered biennium. The even-numbered biennium. So the biennium ends officially 11/30 of the even-numbered year. We are in the biennium that's going to end November 30th of 2018. So we must have our continuing education requirements completed by 11/30 of the even-numbered year. Now, they do give a grace period of 31 days, which means you have until 12/31 to get it done. Otherwise, you lose your license. And the only way to get it back is take the test over. So I want you to be clear on this. Read the question carefully. If you're asked when do you have to have your CEs done, if 11/30 is on the list, I would take 11/30, obviously. If 11/30 and 12/31 are on the list, I'd probably pick 12/31. And of course, 12/30, because you have a grace period till 12/31. It's kind of silly, but you need to be aware. Now, how many hours do you need? If you have one license, you need 16 hours of continuing education every 2 years. Basically, it breaks down. You have to do 8 hours relative to your specialty. 5 hours, I call it a wild card. And then 3 hours must be in Virginia law and regulations. That's 16 every 2 years. And sometimes, ladies and gentlemen, I can tell you, sometimes the material becomes repetitive, especially when it deals with law and regulations, because they don't change a whole lot. Now, if you have 2 or more licenses, then you have to pick up an extra 8 hours in the other specialty. Now, I'm from New Jersey, and when I grew up in New Jersey, the schools I went to, they taught me that 1 and 1 was 2. Well, it seems that in Virginia, 1 and 1 is 1. Here's what I mean by that. You see, there is a life, an annuity, and health license. There's a life and annuity license, and then there's a health license. So a life and annuity license is 1 license. A health license is 1 license. You would think that would be 2 when it comes to CEs. No, no, no. Look what it says at the bottom of my page. Any agent who holds a life and annuity license or a health license or both shall complete 16 hours. So you're going to need to do 16, not 24. Because even though we might normally add up life, annuity, and health as 1 and 1 is 2, it's really 1. That also offers you, this is not for the test, this is just for your information, that offers you the opportunity. You could take courses about life, annuity, or health, and you've satisfied your requirement. So let's see if we can figure this out. I'm not asking you to yell out an answer. I just want you to kind of look at one. John has a life and annuity license. That's 1. His wife has a health license. That's 1. How many hours of CE credits do they need? Answer's 32. If you said 16, what you missed was that. It didn't ask how much does he need or she need. It asks how much do they need. And that's the kind of silly stuff they do on a test to trick you. You'll know it, but you misread it, and you get the wrong answer. Just Not trying to embarrass anybody. I don't want you to feel bad, but I want you to be alert. Let's take it another step. John has a life and annuity license. His wife has property, casualty, and health. Now how many do they need? Now the answer is 40. Because he needs 16, but she needs 24. Because PC and health, that's 2. I hope you get that. No more, no more than 75% of the total hours you need can come from company or agency sponsored courses. Example, you may get a call from your management and they say, hey, we're going to have a meeting, and if you come, we're going to get you 2 hours or 1 hour worth of CE credits. That's okay. Nothing wrong with that. But no more than 75% of your total hours can come from that environment. The state requires that at least 25% of your hours come from some outside unaffiliated educational provider like American Academy for Insurance Training. Just another plug. And again, you have to have it completed by when? 11/30. That's the official date. But they give you a grace period till 12/31. Think about that. Now, if you don't do it when you're supposed to, 12/31, your license is terminated. There's no way to get it back other than take the test again. Some people get waivers under certain conditions. For example, if somebody's really, really sick, you can have a waiver. Or if someone is overseas in the military, they can have a waiver. There are other good causes, but mostly they talk about military deployment and long-term illness. But once a person comes back stateside, they got to catch up. I would recommend anybody in the military on deployment, usually, most of the time, unless they're in a boonies somewhere, have access to the internet. Get it done, okay? Now, some people are exempt. Here's your question. Watch for it. Anyone licensed during the last 12 months of the biennium is exempt for that biennium. Remember, it's even year, odd year. So anyone licensed up through and including 12/31 of the odd year is going to have the CEs done by the end of the next year. You guys are going to have a license, hopefully, somewhere mid-2017. You're going to have your CEs done before the end of 2018 because they will classify you as having been licensed for the full year. See, it's all about the date your license was issued. So if the date your license is issued is 12/31 of the odd year, you're licensed for the full biennium. If it's 1/1 of the even year, they push you forward to the next biennium. Also, those who are consultants, who are licensed agents, of course, they don't have to do both. This next one is what often shows up. Anybody who's old, like 65 or older, by the end of the biennium, held the license for at least 20 years, that's 20 consecutive years actually, with 4 in Virginia, may apply for an exemption. It's not automatic. They got to apply for it. Y'all aren't going to have to worry about that one for a while, but you might see it on a test. Also, non-resident agents, because just like you with a Virginia resident license can get a non-resident license in another state, other states, excuse me, other states' resident agents can get non-resident licenses in Virginia. So non-resident agents who satisfy their resident state requirements don't have to do the CEs. That's reciprocal as well. I'm non-resident licensed in about 6 states. If I had to do CEs for each of those states, that's all I'd be doing 24/7, 365. So because I'm licensed in Virginia, the non-resident states in which I'm licensed do not require me to do their testing or licensing courses. They will accept the Virginia courses I take. If you change your address, you must notify the commissioner within 30 days. Now, I don't know if you filled out the application yet, but when you fill out the application to get your license, there's going to be a place for 3 addresses: a home address, a mailing address, and an office address. They can all be the same. They can all be different. It doesn't matter. However, home address, office address needs to be a physical location. Unless you can prove to the commissioner you actually live or work inside the P.O. box. Okay? Must be a physical location. So if you change any one of those addresses, you've got 30 days to notify the commissioner in writing. And there's a way to do that by going online, which is why I recommend you bookmark the Bureau of Insurance website. Now, different question. If you move out of Virginia, your license is terminated because you're no longer a Virginia resident. So what I suggest to people is if you're planning on moving is generally not a spur of the moment thing. We generally don't wake up on Tuesday and say, okay, kids, we're moving to Arkansas. It's generally a planned event. So plan it. Apply for and get a non-resident license in the state you're going to go to. Understand, the minute you leave Virginia and you cross the state line, your license is terminated. It's referred to as an administrative termination. They call it an administrative termination. Not because you did something bad, but under the law, you're no longer a Virginia resident. You don't have a license. But you still have your non-resident license where you're going. So when you get there, you just ask them to make you now a resident because you moved there. And then if you like, you can call Virginia and using your new resident state, get a Virginia non-resident license and everything is fine. Now, you will have to get reappointed by the companies that you're appointed by in Virginia, because once you lose your license, you lose your appointments. But it's not a tough thing to do. Suspension, revocation, and denial. There are a ton of reasons why somebody can have their license suspended, revoked, or denied. Somebody gets caught cheating on a test. Somebody gets caught forging their name to a document. I mean, this is not like rocket science, okay? But here's the one that tends to confuse people and mess them up. The difference between being indicted for a felony as opposed to being convicted of a felony. You don't lose your license if you've been indicted. An indictment is not a conviction. Most of you probably know that. So you would lose your license if you're convicted, but you don't lose your license if you are indicted. Read the question carefully. Now, if your license is denied or revoked for any of those reasons, you got to wait 5 years before reapplying. You got to be licensed at the time of the sale to earn a commission, but you don't have to be licensed to get your ongoing renewals if you're entitled to them. So the state doesn't care. You got to be licensed when you first make your first commission on that sale, but if you ever are entitled to renewal commissions, the state says you don't have to have a license to do that, to get that. And as I mentioned a couple of times, the insurance companies can only pay to properly licensed agents, which is why if you want your commissions being paid to your agency, you must get that agency licensed business entity. Administrative fees. What's an administrative fee? Well, let's assume you're sitting in your office and somebody walks in the door and they say, I want to buy some insurance. You say, great, I charge $20 to fill out the paperwork. That's an administrative fee. So if you're going to charge an administrative fee, that's legal. You can do that. But what does it say here? You must have a schedule of fees posted so that everybody can see it. And you must have the client sign a copy of the fee schedule. That's what's required. You'll notice it doesn't say give the customer a copy of the fee schedule. That is not required. Remember, you must keep your records for 3 years. So that's client's signature on a copy of the fee schedule. The state wants you to keep it for 3 years. You're not required to give the customer a copy. Now, would I give them a copy? Of course I would. But you have to read the question. Don't read into the question. They're asking you what's required. Okay. The requirement is schedule of fees posted. They have to sign a copy. You keep it for 3 years. Now, if you get convicted of a felony, remember, convicted, not indicted. If you get convicted of a felony, you've got to notify the commissioner within 30 days so she can take your license. You might get it back after 5 years if you want it. But if you don't notify the commissioner and she finds out on her own, I can almost assure you, you'll never get your license back. There are certain marketing practices that they're going to ask you about. Some are obvious and some are not. Rebating. Rebating is illegal. Rebating is bribing somebody to do business with you. So anything of value that you give to somebody to induce them to buy from you is a rebate. Now, somebody asked me once, well, wait a minute, don't they draw a line somewhere? Well, yeah, nominal value things, calendars, pens, that's not a big deal. If you take a client to dinner and you pay for it, that's okay. Take them to a ball game, you pay for it, that's okay. But if you give them a gift certificate to go to dinner or give them tickets to the ball game, that could be treated as rebating. So you got to be careful. Just go with them. Have fun. It's all right. Both the offer and the acceptance of a rebate is illegal. Of course, they can't do much to the other person, but they can take your license away or fine you. Misrepresentation. We're not allowed to lie. If we lie, we can be fined or maybe lose our license. Defamation. I used to work for a guy, I should say with a guy. He was a great guy. He never got out of the 8th grade. He had a hair lip, talked really funny. He was in Marion, South Carolina. He was worth like $300 million when I met him. And he made a fortune in sales. That's where he made his fortune. So I paid attention when he talked. I could learn from this guy. If I could understand what he said, I could learn from him. But he was a great guy. But he used to have some funny sayings. And one of the sayings he would harp on us often was, whenever you throw dirt, some of it gets on you. So defamation is not only illegal, but it's stupid because the person you're talking to really has a different opinion of a person who's maligning someone else. If you haven't got something good to say, don't say anything, okay? But in our world, anytime we say anything that's maliciously critical of any entity or person in the business, we could be fined or lose our license. Can't do that. False advertising. I know you know false advertising is illegal. That's not the point here. But how we identify the policy becomes important. So if I were you, I would never try to come up with a fancy way of saying the name of a policy other than the way the insurance company identifies the policy. So you don't want to say this is a charter policy because the state says to themselves, this person's calling it a charter policy. Well, a person who's a charter member of an organization is an elite group. Only a few people can be the charter member of anything. That's misleading because anybody who wants and can qualify for the policy can have it. So it's misleading to make somebody think that there's something special by indicating they're a charter something. Can't do that. The other one, a lot of life insurance agents fall into this trap. They just don't seem to get caught. Life insurance is not an investment contract. Can't call it that. Now, some of the variable products we talked about have an element that there's an investment, but it's not an investment contract. It's a life insurance policy. If you remember back to one of the early things we discussed, the purpose of life insurance is to replace the income of a breadwinner. Nowhere did we say the purpose of life insurance was to make investments grow. Now, that's a secondary reason somebody might have it, but it's not an investment contract. We also have to be careful. We cannot boycott, we cannot coerce, we cannot use intimidation. Let's focus on coercion. I mentioned to you guys a couple of days ago, somewhere along the line, I said banks can require as a condition of a loan that you have insurance. That is not coercion. It becomes coercion if they make you buy it from a specific agent or company. So that's not legal. They can't do that part. So coercion is illegal. Marketing practices. In the world of insurance, we can discriminate, not we, but insurance companies can discriminate against people based upon factors that in the real world you cannot. Example, in the real world, discriminating against somebody because of their gender is illegal or because of their age is illegal. But we do it all the time in insurance, and we, meaning insurance companies. Women pay less for life insurance than men. That could be construed to be discriminatory against men. Old people pay more for life insurance than young people. Again, that could be considered to be discriminatory against old people. So we've developed a list called, I refer to it as my taboo list. Insurance companies may never, ever discriminate against anyone based upon these items: race, religion, color, creed, national origin, sexual preference, or domestic violence. Domestic violence is a relatively new addition to this list. Of course, up until, well, more than a few years ago now, but up to a while ago, insurance companies did not want to insure women, especially where they were in a relationship where there was violence. Why? Because they got hurt, and that would meant doctor bills, or sometimes they died. So insurance companies didn't want to touch that stuff. Well, laws have been changed. They can no longer discriminate. So if they could prove, let's look at national origin. If they could prove Italians live longer than Frenchmen, you can't charge the Frenchman more money because he's going to die sooner as a population. Because now we're discriminating against them because of their national origin. I hope you get that. There's one that's not up there. I want you to write this down. Marital status. Marital status. Insurance companies may and do discriminate against somebody based upon their marital status. Now, in life and health insurance, it's not done. But in auto insurance, it is. And even though you're not taking the auto insurance test, this is about all lines of insurance, this particular topic we're on now. So and some of you may already know this. You ask some 23, 24-year-old young man who's single what happens to his auto premium if he gets married. And if he knows or checks it out, his premium's going to go down because he's married. So marital status is a potential for insurance companies to discriminate. Twisting. Twisting is illegal. When I was a young man, we had a dance called the twist. My parents used to think that was illegal. If my parents were saw what goes on some of the dance floors today, they'd be spinning in their graves. Some of that stuff has to be illegal in public. They need to get a room. Some of that, I know I'm dating my old fartness here, but now we're not talking about dancing. Twisting. Twisting is illegal. Here's what twisting is. If we lie to somebody to induce them to lapse, cancel, surrender, or switch a policy, then it must not be in their best interest. So therefore, that's illegal. Misrepresenting to induce someone, that's illegal. But read the question, huh? It is not illegal to induce someone to lapse, cancel, or surrender a policy because it might be in their best interests. So as long as we fully disclose and the customer understands what's going on, it might be in their best interest to get rid of that stupid term policy and replace it with an indexed universal life product. But they have to understand the reasoning, okay? So read the question carefully. Twisting is when we misrepresent. If we have to lie to them, it's probably not in their best interests. But if you just plain old inducing them, trying to talk them into it, if you could prove that they're going to be better off, then you probably ought to do that. The Virginia Insurance Guarantee Association. Very simple. It's a group, it's an organization established by the state. And the purpose of the association, by the way, that's the official title, the Life Accident and Sickness Guarantee Association. That's its official title. Sometimes the state refers to it as Virginia Insurance Guarantee, and sometimes they call it the Life Accident. So I want you to know it's the same thing. Why does this association exist? It's designed to protect the public when an insurance company becomes insolvent. Every admitted insurance company is required by state law to belong to the association that's relative to the products they're selling and the funding of that association, because what they'll do is come up with money if an insurance company goes bankrupt. If an insurance company becomes insolvent, they'll help the client out. So where does the money come from? Question, how is it funded? It's funded by what's referred to as a premium tax. A premium tax. Every insurance policy sold in Virginia has in it somewhere a premium tax. Think of it like a sales tax. And when the insurance company gets the premium, they have to take out the sales tax and send it to this association in much the same way a retailer sends sales tax to the state. That's what funds the association. So this is not a guarantee, however, even though they call it a guarantee. A state can call it whatever they want. If we use this term and it does what this does, they'd put us in jail for fraud because it doesn't guarantee anything. It's a safety net. So what do I mean by that? Well, here's what you may see on the test. The maximum benefit the Guarantee Association will provide if an insurance company becomes insolvent is $300,000 per life. So if Mary has 10 life insurance policies on her husband and he dies, what is the most she can expect to get from the Guarantee Association? Answer is $300,000. See, it doesn't matter how many policies he has. The question is, what is the most she's going to get from the Guarantee Association on his life if the company or companies are insolvent? $300,000 on a life. So that's not a guarantee, is it? It's a safety net. Now, some policies have cash value. Remember, permanent policies have cash value? Well, the Guarantee Association is only going to stand by for up to $100,000 of cash surrender value in any policy. So again, that's a safety net, not a guarantee. Don't be panicked here. I want you to get this. I don't know if I mentioned this to you guys in class, but I usually do, but in case I didn't. Has anyone ever heard the word insurance-rupt? Answer is probably no. You've heard the word bankrupt. Insurance companies don't go bankrupt. Insurance companies don't go out of business. The most heavily regulated industry is the insurance industry. Insurance companies are the most heavily regulated businesses in the country, primarily because they are regulated at the state level. The closer the regulator is to those being regulated, the more effective the regulation is. But anyway, now, you and I may not discuss the idea that the policy's got a Guarantee Association behind it. We're not allowed to do it. Insurance companies cannot advertise the fact that their policies are backed by the Guarantee Association. The state says no one company can even discuss it with their customer because if one company does it and another company does not, the customer might infer that the company who did not discuss it doesn't have the guarantee, and that's not true. So we can't discuss it. Insurance companies can't discuss it, period. We've already talked about adverse underwriting. We're not going to go over that again. Nothing new there. Then we have a page I'm going to send to you. It's called Numbers, Dollars, Days, and Dates. And the reason I'm going to send it to you is on that page is about 80% of everything you need to know from the chapter we just finished. So it's all in one place. It's kind of like a little cheat sheet. Somebody said to me once, why didn't you just give us that and move on? Because you wouldn't have listened to a word I said, and you wouldn't have the comprehension you currently have, even though you think you're screwed up. So we're going to send you this Numbers, Dollars, Days, and Dates tonight when we're done. I like Thomas Jefferson. He's a cool guy. All right, now, we're not done, and then we're not going to take a break. We're just going to continue. We've got 2 more sets to go through. They're pretty quick because I know you want to be done and I want to be done. We've just done all lines. Now we're going to do health only, and then we're going to do life only. They're pretty quick. As soon as it loads up. What happened? What happened? What happened? Bear with me. Oh, that wasn't the one I wanted. Health only. There it is. Health only. It's only about 20 slides here. We do health only and then life only. So we had all lines, health only, and life. Okay, so we're almost done. On the test and in real life, Medicare supplement policies and long-term care policies basically have the same rules because they're basically dealing with the same target market, older folks. Now, Here's where the question, this is a little weird, but here's how the questions go. They may ask you about how an insurance company determines how they're going to deal with premium upon renewal. So here's what I mean. Actually most companies use what's called the attained age method of determining premium upon renewal. The attained age method. Your attained age is your birthday, closest birthday within 6 months. That's your attained age. So the attained age rating method happens. The premium increases as you get older. That's normal. That's what most companies do. Now, in life insurance, the premium is always level. But if you buy 1 year renewable term, every year you renew it, your premium is going up because you're a year older. Health insurance, it goes up every year because you're older. Some, not many, some companies use what's called the issue age method. And the issue age is obviously the age you were when you bought it. So with issue age rating, premiums do not increase. So what is the difference? MedSup and long-term care. Attained age, premiums increase. Issue age, premiums do not increase. Just watch for it. All long-term care and MedSup policies are required to be guaranteed renewable. We went through those, right? Guaranteed renewable, non-cancelable guaranteed renewable, and then the ones above it, which are rarely ever happening. Almost every medical expense policy in Virginia is guaranteed renewable. Disability income policies, guaranteed renewable. Long-term care, Medicare supplement, guaranteed renewable. Life insurance policies don't have to be guaranteed renewable. Term policies do not have to be. Many of them are, but they don't have to be. But in health insurance, most of them do. Also, when it comes to health insurance, an insurance company cannot indemnify. Remember we talked, that's what insurance does, right? It indemnifies us. It makes us whole again. It cannot indemnify somebody differently because they got sick as opposed to getting hurt. The dollar amounts have to be the same. Because a Medicare supplement policy is going to pay some or all of Medicare deductibles and copayments. Doesn't matter whether you got sick or hurt, there's a bill to pay. That's the point. And no MedSup, no long-term care policy can duplicate Medicare. That should make sense to you. Why would you buy a policy that is going to duplicate Medicare? I'm paying for something I'm already getting. I can't collect twice. So none of these policies can have any provisions that duplicate Medicare. Just a reminder, when we talked about pre-existing conditions, we talked about long-term care and Medicare supplement policies. There's a 6-month pre-existing condition clause. They can look back 6 months to see if you have a pre-existing condition. And if you have one, they can make you wait 6 months, not wait 6 months. They can temporarily exclude coverage for only up to 6 months. I already went through this a little bit ago. Anybody that turns 65 and then enrolls in Part B, or better yet, let me say it a different way. Anybody who enrolls in Part B, no matter what their age, as long as they're 65 and older, anybody who enrolls in Part B has 6 months from doing that to buy a Medicare supplement policy, guaranteed issue. Only Medicare supplement policies have this guaranteed issue within 6 months of enrolling in Part B, not long-term care, Medicare supplement. But even though they have this guaranteed issue, if you buy it within 6 months of enrolling in Part B, they can still impose a 6-month pre-existing condition clause, but only 6 months. It's just that they can't deny you or charge you more premium. Advertising. Insurance companies must file a copy of any ad with the commissioner. Notice what I have in red, it says file a copy. Nowhere does it say get the commissioner's approval. It is not required you get the commissioner's approval. Not you, but the insurance company. They only have to file a copy. If the commissioner does not like the ad, she'll tell them to pull the ad, the way that works. Now, the second bullet. All advertisements, no matter who created the ad, is the responsibility of who? The insurance company. Therefore, if some insurance agent in Butte, Montana, puts an ad in a church bulletin and it manages to violate Montana law, the insurance company's got to be held responsible, not the agent, by the state. Now, the company might want to fire the agent. That's a different deal. But the agent is not going to suffer any penalty under the law. It's the insurance company because it's their responsibility. Also, what I don't have here, testimonials. Make a note, testimonials. Y'all know what testimonials are. Advertisers use them all the time. But in insurance, any testimonial must be the current opinion. That's the key. Must be the current opinion of the person making the testimony. So any testimonial to advertise any insurance product must be the current opinion of the person making the testimonial. Long-term care, we said it's just like Medicare. It's like medical expense policies. Premiums are tax deductible. The benefits are tax-free. Advertising. Here's where I got to get you to separate some things in your brain. We have regular, plain, vanilla long-term care and partnership long-term care. I'm not going to get into a big discussion about partnership. I just want you to put them each in a different box in your brain. Generally speaking, long-term care advertising must be kept for 3 years. Obviously, they have to file a copy. We just talked about that. Any ad requires they file a copy of the ad with the commissioner. But earlier tonight, we talked about the fact that partnership long-term care ads must be kept for 4 years. But what I refer to as plain vanilla long-term care, they have to keep those ads for 3 years. So there's a difference in time as to how long they have to keep the ad on a regular long-term care policy as opposed to a partnership plan. 3 years for the regular, 4 years for the partnership. Long-term care policies, the agent is required to make sure that the policy sold to the client is a suitable product for the client. It's up to us to make sure that they have the ability to pay for it. It meets their goals, needs, and desires. If we're replacing one with another, we have to make sure they're going to be at least as well off, hopefully better off than they were before we met them. Now, you really don't have to worry too much about coming up with a way to do this, because insurance companies who sell this stuff, if you get appointed by them, they will provide you with a questionnaire that you will use that will help you determine about their suitability. But the test may ask who's responsible to make sure that long-term care product is suitable to the client. It's the agent. Renewal. All long-term care policies, I've said this more than once, must be guaranteed renewable. And almost every medical expense policy, if the policy is terminated, the ongoing claims must be continued. If a policy is being canceled, it's being canceled for future claims. They can't pull the rug. You've already agreed to pay your hospital bill, and then if they can, which they normally can't, but if they're able to and cancel your policy, they can't not pay for what they've already agreed to pay for. It's for future claims. So ongoing claims must be honored. One other thing about long-term care. See, that ongoing claims is for all health insurance. But the next one at the bottom is specific to long-term care. Whenever we make a presentation or a sale or to a client about long-term care, we're required by law to hand them a booklet. The book is referred to as a shopper's guide. That shopper's guide is also provided to us by insurance companies. It's a pretty nice little book, and it helps them understand stuff. So the shopper's guide that we have, we must hand it to the client before we make our presentation. Partnership plans. I got to give you a quick overview of partnership plans. Not a big deal, just a little overview. So I want you to visualize this. I'm going to go quickly, but stay with me. If you have questions, interrupt me. Medicaid. We said earlier tonight that Medicaid will provide long-term care benefits for those people who qualify for Medicaid. And how do you qualify for Medicaid? Basically, you're broke. You don't have any assets. Well, people who have money have the ability to hire legal brains to help them hide assets. So they don't have any assets. So if they need long-term care, they can get on Medicaid and Medicaid will pay the bill. Well, that's not cool. Also, when you consider, think about this, this is not for your test, but I want you to consider this. 69% of every Medicaid dollar, 69 cents of every Medicaid dollar that's spent is spent to care for a senior citizen in a long-term care facility. That's a significant part of the budget. So the state is not anxious to have people arrange their affairs in such a way that they have no assets, because now they're digging into the pockets of the taxpayers. That's you and I that pay that. So the state has come up with a plan. See, it's what they're doing, what the rich people are doing is not illegal. And I'm not against rich people. I can promise you I'm not against rich people. But the state is saying, look, rich guy, we know what you're doing. It's legal and we don't like it. But we think we have a better way than you paying hundreds or thousands of dollars, tens of thousands of dollars to an attorney to get this done. Here's what we're going to do. If you will buy an insurance policy for long-term care from one of the companies we partner with, like a John Hancock or a New York Life or a Genworth, these are strong, solid companies who are going to pay their claims. If you will buy, and a partnership policy has unique benefits. If you will buy one of these partnership policies, we will allow you to set aside $1 worth of assets for every $1 worth of benefit you get if you need long-term care. So if you own this policy and it's going to pay you maybe $5,000 a month for 10 years, that's a lot of money. A couple of $1 million. I don't know. I can't do the math right now, but that's a lot of money. So if you need long-term care and you have this partnership plan, that policy is going to start paying you. If it runs out of money because you're still alive and you've exhausted the contract, we will allow you to set aside $1 worth of assets for every $1 you received. You don't have to spend them down. You don't have to spend those first before you go on Medicaid. That has the advantage of delaying their access into Medicaid, and sometimes they die before they get there. So these partnership plans are tied to Medicaid. Because of that, Medicaid is a state program, right? Managed by the states. So these partnership plans are not available in every state. Each state may have one or may not. Virginia does. So if you're going to buy a partnership plan in Virginia, you got to be a Virginia resident. Not only when you buy it, but when you use it. Because if you move to North Carolina and you expect to get your assets set aside, North Carolina does not have to honor the promise Virginia makes. So you got to be a Virginia resident when you buy it, have to be a Virginia resident when you use it. These policies are required to provide inflation protection, a minimum of 3% a year, which means the benefit the person buys is required by law to increase by 3% every year. That has the effect of making the benefit last longer, because as costs go up, the value of the benefit keeps pace. Now, once a person has exhausted their policy, they're not automatically qualified for Medicaid, because the state is going to look around to make sure there are no assets in excess of what they got out of the policy. And because any assets in excess are going to have to be spent down. They have to spend them first before they're going on Medicaid. You and I as agents, if we want to sell partnership plans, we've got to take a specific course every 24 months. Initially, we must take an 8-hour course specific to partnership plans. Every 2 years thereafter, take a refresher, 4 hours. Make a note. These hours are part of, not in addition to, your normal 16. So you don't have to pick up an extra 8. You just pick up 8 as part of your 16. You don't have to pick up an extra 4 from that point forward. Just pick it up as part of your 16. Part of, not in addition to. And then with partnership plans, we're coming around full circle now. We've talked about this earlier. Advertising. All ads, remember, including partnership plans, file for review. Partnership plans, they have to retain those ads for 4 years. Plain vanilla, 3 years. And then training records, Those courses we take that we just mentioned in the middle of the page, insurance companies have to keep records for 5 years of those training sessions. Don't worry about the list. Forget it. No big deal. That's no longer on the test. I should get rid of it. What I want you to focus on is under the also. We have to be very careful how we identify ourselves to senior citizens. I probably mentioned this more than once to you, but senior citizens are a protected species. We're not endangered. There are more of us every day. If you're lucky, you'll get here. It isn't a bad thing, okay? But we have to be very cautious in dealing with seniors. We can't say something like, I'm a senior advisor. I'm a retirement specialist. Can't do that. That implies you're something above and beyond a typical agent. We can't do that. Okay. Famous. What the hell is famous? Some of you may know. Famous is an acronym. It stands for Family Access to Medical Insurance Security Plan. FAMIS. Famous. Who is it for? Poor kids up to age 19. Not all kids up to 19. Only poor kids up to 19. They have to be obviously residents of Virginia. And how do we know if they're poor? Family income level has to be at or below 200% of the federal poverty level. If they get that, if they're at that level of income and they're 19 or younger, they can qualify for famous. That's the only 4 things you need to know. The rest of the points are not important. Now let's talk about the NAIC. The NAIC, National Association of Insurance Commissioners. I think I went over this with you, but we're going to make sure you get it. So write it down if you don't already know it. National Association of Insurance Commissioners. 55 egomaniacs who run the various bureaus and departments of insurance across all the jurisdictions. So it's a group of state insurance regulators created, the state insurance regulators created the NAIC. You don't need to know the year, but understand they are state regulators. I would take some time to review this slide and become familiar with it because it tells you a lot about the NAIC. Organization of Insurance Regulators from the 50 states, DC, and the 5 U.S. territories. Look what the end of it says, and I'd underline this. The NAIC provides a forum for the development of uniform policy procedures when uniformity is appropriate. And you may have missed this, but when we were going through the policy provisions clauses and riders, we mentioned that there's a uniform policy provisions law. Well, that's part of what the NAIC does. Now, there were 3 events, count them, 3 events that have occurred in the history of insurance regulation that have impacted insurance. I'm not here to give you a lesson in the Constitution or the founding of our country, but there are certain things I need to lay some groundwork on. When our country was founded, the founding fathers had a lot of discussions about whether we should have a strong central federal government or a strong state government with a weaker central government. The people who wanted a strong federal government were called statists. And the people who wanted a weaker federal government but strong states governments, states' rights, were called federalists. The federalists won the day because never in anywhere in the Constitution does it say that the federal government gets to regulate insurance. As a matter of fact, the first 10 amendments, the first 9 of the 10 amendments are specific restrictions on federal government. And the 10th Amendment is the amendment that says the only power the federal government gets is what the states give. They call it the Enumerated Powers Amendment. The 10th Amendment is called the Enumerated Powers Amendment. I'd recommend, if you haven't read it, you need to read it. You're going to wonder what the hell is going on with our country. Anyway, so therefore, the states were always meant to be the exclusive, key word, exclusive regulators of insurance. If you remember earlier, I said they're the primary regulators. So something changed, huh? Well, we got to track that change, and this is what you'll need to know. 3 events. When we get done with this, you're going to need to know or remember to some extent the name of the event, the what is the event, and the result of the event. So let's take the first one first. Paul versus Virginia. Paul versus Virginia is a Supreme Court decision. The year is not important for your test. It's just here to give you, again, a point of reference. So here's what happened. Let me give you the background. An agent named Paul, last name Paul, was selling insurance in Virginia, but he was selling insurance for a New York company. And the state catches up with this dude and figures out, hey, man, you don't have a license. You got to have a license to sell insurance in our state. We're the regulator. You got to have a license. And he said, no, you guys don't get it. There's a clause in the Constitution called the Interstate Commerce Clause. And the Interstate Commerce Clause, I'll paraphrase it for you, is basically any act of commerce that affects 2 or more states will be regulated to the federal government. And his argument was based upon the idea that a policy that he sold from a New York company had to cross the state lines of a number of states before it ended up in Virginia. So he argued insurance should be considered interstate commerce. The feds have the right to regulate it, and you don't have a right to make me have a license. Well, this ended up at the Supreme Court. And the Supreme Court basically threw him out on his ear. They said the court held delivery of an insurance policy in Virginia issued by a New York company, what's in red? Not interstate commerce. So what do you need to remember from this discourse I've been through? What is Paul versus Virginia? Supreme Court decision. What is its name? And what is the result? Not interstate commerce. And as a result, the states remain the exclusive regulators of insurance. And that stood until 1944. And when another lawsuit brought by the United States Department of Justice against a group of underwriters called the Southeastern Underwriters Association. Now, Paul versus Virginia was settled law, but they managed in this U.S. versus Southeastern Underwriters, they managed to bury another argument about having the federal government regulate insurance with interstate commerce. And this Supreme Court reversed Paul versus Virginia and said insurance is interstate commerce. So what have we got so far? 2 Supreme Court decisions. One called Paul versus Virginia, one's U.S. versus Southeastern Underwriters, and they are in conflict with each other. One says insurance is not interstate commerce. The states are the exclusive regulators. The other one says insurance is interstate commerce, and as a result, the states have lost the right to regulate insurance. Well, now, with this conflict, Congress had to step up and pass a law, and this is the law we live under today. It's called the McCarran-Ferguson Act. It's also referred to as U.S. Code 15. McCarran-Ferguson Act was a compromise. I'm going to paraphrase the compromise. I just want you to understand what's going on here. The compromise basically went like this. McCarran-Ferguson Act agrees that insurance is interstate commerce. So they went along with the Southeastern Underwriters decision. Insurance is interstate commerce because now the feds get to regulate insurance. The feds were trying to regulate insurance forever. Now they got their chance in 1945. So they said insurance is interstate commerce, but they put a but in. However, as long as each state doesn't make it difficult for insurance companies to do business among the states, we will let the states be the primary regulator. So the federal government was willing to take like a back seat. They'll act like an overseer. They weren't going to regulate insurance actively. They were just going to sit back, look over the shoulders of the states, and as long as the states did an adequate job of regulating insurance and didn't make it difficult for insurance companies to do business among the various states, the Fed said that's no problem. The states can be the primary regulator of insurance. Well, that all came to a head when the Affordable Care Act passed, because under the Affordable Care Act, the federal government got the exclusive right to regulate health insurance. That was that nightmare. Now, our test doesn't go that far. So what do we got? 3 events. 2 Supreme Court decisions, and a federal law. Was not interstate, states remain exclusive. Is interstate, state lose the right to regulate. Compromise. Hope that makes sense to you. I'm going to send you guys a copy of this. I got one more set of slides to go through, and just hang in there with me. I'm going to send you guys a copy of this. This is one of the few things I have hanging on my wall, because the only time you lose is when you quit. The only time you lose is when you quit. Memorize that, because you're going to have some tough days. This business is not easy. Not a question of being easy. The question you have to ask yourself, is it worth it? Well, when you can reach a position where you're knocking down $250,000 a year and you're not having to do a lot of selling to do it, and then your residual income starts pushing $300,000 a year, you're going to find that as hard as it was certainly worth it. Anyway, I don't want to belabor that. We got one more set to go through, and we're going to be done. There it is. Life only. Oh, why is that working? That didn't work. I'm not supposed to do that. Hold on, let me open it for you. The hell is it? Huh. I usually have this thing lined up ready to go. All lines, health, 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 all health, life. That's not it. That's not it. That's the one I didn't like in the first place. Cheese and crackers. Hold on. Life. Let me do it this way. Something has happened. Let's take about 2 minutes. I've got to dig something out. 2 minutes. You got 2 minutes. I'll be back. It's audio. What the hell's going on with this thing? There we go. There we go. Okay, sorry for the delay, but here we are. Life only. We did health only, we did all lines, and we do life only. We've already talked about suitability in annuities. This is kind of an overlap, so we're not going to get into that again. No big deal. Replacement. One of the things we talked about was replacement of life insurance. We talked about it earlier, yesterday or the day before, how that replacement had to be monitored and regulated, especially with life insurance. We had that form to be filled out and read to them. But there's a question about why are all these regulations there about replacement? Well, here's where the answer is. The purpose of having these replacement regulations is not to eliminate or forbid replacement, but to regulate it and to establish minimum standards of conduct that you and I must follow so that replacements are done ethically, not to prohibit replacement. Don't worry about the definition. It's not on the test. Group life, we've already talked about group life, 10 or more employees. One of the things we didn't mention was this little bullet. I don't know if this follows along exactly with your slides or not, but if it doesn't, just make some notes. And if you want, I'll email this to you. Group life has to be for the benefit of the employee. That's just a silly question. I think we talked about credit life, how credit life had to be for the benefit of the creditor. I don't think this is the wrong one. This is the wrong slide. Hold on, that's the wrong one. It's an older one. That's too many. This is probably the one. Nope, I can't use that one. Damn it. Huh. Well, my computer is not cooperating with us tonight, folks. Shit. That's not PowerPoint. No, I'm afraid. No, that's what we've already talked about. I don't know what's happened, and I'm usually better at this. I can't believe that this is how. What the hell is going on? Huh. Try it one more time. Oh, I got that. Nope. Something's gone wrong. God. Murphy's Law, Murphy's Law, Murphy's Law. I don't work well under Murphy's Law. Somehow or other, it looks like it's gotten deleted, and that's terrible. Well, you're going to have, and I hate to go to this, but you're going to have plenty of test questions on the exam simulator and stuff you're going to be using. So that will work for you. Also, I'm going to send you the numbers, dollars, days, and dates. And then just take and go through the slides you have. You should have a copy of the life only statutes and regulations. And your copy is a PDF file, and I have it, but I don't have the PowerPoint that I use. So we're just going to have to forego it and let me know if you have any questions. There's not a lot of information that we haven't already covered. Most of the questions are going to be about the all lines, especially continuing education, stuff like that. So if you have any questions that come up while you're studying, get a hold of me. I mean, that's about all I can say to you. Just get a hold of me because I don't know any other answer to this problem. Nope, that's a PDF file. Somehow or other, I'm just hoping against hope. But you guys have been patient. So anyway, let's just do this and we'll call it a night. You guys have gotten like 90% of what you need to have. I promise you that. And go through the material that you have. Make sure you go into the cram course. That is really where you need to spend your time. go into the cram course and make sure you get a hold of me should you have any questions. Can't help you if you don't ask me questions. It's been a pleasure to work with you guys. I apologize for the glitches, but you know, life sometimes takes turns and we have to just overcome. Unless there are some specific questions at this time, we're going to call it a night. Anybody got any specific questions? All right. So with that,